or equity to the other entity within that particular what? A contract. Now, once these financial instruments have been issued, a company, for example, has issued shares, a company has issued debentures, or a company has invested in shares or debentures. In terms of how the company should account for that, for those shares, for those debt instruments, either issued or purchased, that is governed by IFRS 9. IFRS 9 stands for International Financial Reporting Standard number 9, and it's also important for you to note that this is basically a new standard which was issued to replace the old standard on financial instrument. That is, the old standard was International Accounting Standard number 39. This standard has been scrapped. In other terms, we say it has been superseded. It has been superseded. Superseded means that it has been done away with and basically replaced by the new what? By the new standard. If you can be able to recall, even in our previous topic, the topic on leases, we said current leases are accounted for in accordance with IFRS 16. And actually, we said IFRS 16 is a new standard issued to replace the old standard on leases, which was IAS what? 17. So that standard has been superseded, scrapped, and replaced by IFRS 16. In the same case here, we are saying IAS 39, which used to govern how financial assets were measured and also accounted for, that standard has been superseded, scrapped, and replaced by IFRS 9. So currently, financial assets, financial liabilities are basically measured and also accounted for in accordance with IFRS what? 9. And therefore, majorly in this particular topic here, we are going to look on two items. One, financial asset. What are financial assets? Basically, you have said this is an investment in shares. It is an investment in debt instruments like debentures. How we classify financial assets in accordance with IFRS 9, and how do we determine the value of financial assets once they have been acquired, and also at the end of each year, equally in accordance with IFRS 9. Also, we're going to discuss on the aspect of financial liabilities. Financial liabilities basically have said these are the debt instruments issued by the company. If a company issued debentures, issue bonds, and so on, that is a form of financial liability. How do we classify those financial liabilities? And equally, how do we measure their value in the statement of financial what? In the statement of financial position. So, but before we look on that, next, I want us to look on something to do with recognition of financial instruments, recognition of financial instruments. So basically, in this case, when we talk about to recognize or recognition automatically this comes from that to recognize. To recognize this is the process of recording an asset or a liability. It is a process of recording an asset or a liability in the company's books of account. As an accountant, once a company acquires an asset, once maybe a company acquires a liability, you have to recognize that in the company's books of account. That process through which you record an asset or liability in the company's books of account is, we refer to that as recognition. Now, a question arises here. If, for example, a company issues shares, from the example which I've given, company X has issued shares, or maybe this company has issued some debentures, and some of those shares or debentures have been issued to company Y. So when should each of these companies recognize those shares or debentures in its books of account? According to IFRS 9, financial instruments should be recognized in the books of account of these two companies when an entity becomes a party, when an entity becomes a party to the contractual relationship. In other terms, these shares or debentures should be recognized in the books of account of this company, when the companies enter into that contract. It basically means that if a company has issued shares here, the company should not record those shares in its books of account once the company receives cash, but they should be recorded once the company has issued those shares. It is obvious that those particular shares will have to be paid for. They should be recognized, they should be recorded once they have been issued, and not when the cash has been received. The same case here. Once this company has purchased or basically invested in shares or basically debentures of this company should record those shares or debentures in its books of account whenever the company becomes a party to that contract, not when those shares or debentures will be paid for. But once they have been purchased, even if they will be purchased for on a future date, they should be recognized. So therefore, financial instruments should be recognized when an entity becomes a party to the contractual relationship. Then next, we have the recognition, something known as the de-recognition, the recognition of financial instrument, the recognition of financial instruments. So what do you mean by de-recognition? The recognition basically is the direct opposite of recognition. Recognition, you have said, is a process of recording an asset or liability in the company's books of account. The recognition is the process of removing a previously recognized financial asset or financial liability from the entity's books of account and also the statement of financial position. So we say this is the removal. Is the removal of a previously recognized financial instrument from where? From entities' statement of financial position. That process of removing financial instrument from the entity's statement of financial position is called recognition. For example, in this case, let me give a good example so that you understand. Assuming we have a company here, or this company, company X, and this company has issued debentures having a life of 3 years. A life of 3 years. What does that mean? It basically means that our company here, for the next 3 years, will have to pay interest. And then at the end of the 3rd year, those debentures mature. And once they mature, the company will have to do what? To redeem them. The company redeems them by returning the principal amount which was invested by the debenture holder. So we say that at the end of the 3rd year, or once 3 years are over, these debentures will no longer be shown as a non-current liability in the statement of financial position of this company. Because once a company has issued debentures, we know those debentures are shown here in the statement of financial position as a non-current liability. But once they have been redeemed, the company has paid back, or the company has redeemed them. Should the company continue showing them in the statement of financial position as a non-current liability? Automatically no, because they have already matured, they have been what? They have been redeemed by the company. So therefore, that process through which an entity removes previously recognized financial instrument from its statement of financial position, we refer to that as what? The recognition. Now, in this case, let's look on the criteria for the recognizing financial instrument. Now, those criteria, the criteria for the recognition, they are basically classified like into 2 categories: criteria for the recognizing a financial asset, criteria for the recognizing a financial liability. So let's start by looking on the criteria for the recognizing financial assets. So even before you look on this, you have to recall what are financial assets. Financial asset, basically, you have said it is an investment in shares. It is an investment in debt instrument. For example, our company here, company Y, has invested in what? Debentures. It has invested in shares issued by company X. That is a financial asset. So a question arises: if this company has invested in debentures or shares, when should this company remove those financial assets in its books of account? We have 2 circumstances when that may happen. One is when the right to receive cash, expires. When the right to receive cash expires. What that means is that in this case, you may have, for example, this company may have invested in debentures having a life of 3 years. So it basically means that this company will have the right to receive cash for the next 3 years, the interest on annual basis for the next 3 years. At the end of the 3rd year, this company should be given back the principal amount. Just like the way you can invest in government securities. If you invest in treasury bonds, the treasury bonds, these are securities issued by the government. Whenever the government is doing domestic borrowing, If you invest in treasury bonds having a life of 3 years, you will earn interest. You'll be paid interest by the government in year 1, year 2, year 3. And then at the end of the 3rd year, you'll be given back the amount you had invested. If you had invested 2 million, you'll be given back your 2 million. It basically means that your right to receive cash at the end of the 3rd year will do what? Will expire. So if you are a company, can you continue showing that as an asset, as an investment in your books of account, yet you have been given back your money? No. So you have to recognize, you remove. So therefore, financial assets are recognized. Number 1, when the entity's right to receive cash do what? Expires. Number 2 is when the entity transfers the rewards and also the rewards and risks associated with a financial asset. When the entity transfers the risks and rewards associated with a financial asset. What do you mean by transferring the risk and the reward? This whereby if you have invested in some shares or debentures, we know that any form of investment has some reward. For example, if you invest in debentures, the reward you're entitled to is the interest. Also, anytime you have undertaken an investment, we know any investment has some risk. This is something you have covered from FM. There are some risk associated with any form of what? Investment. So if you transfer the risk and the reward associated with a financial asset, you be recognized. To transfer in very simple terms is to sell. To transfer in very simple terms is to do what? To sell. Like in this case, our company had invested in shares or debentures, but that company sells them to another company here, maybe company F. So once that company do that, it sells those shares or debentures. We say this company has transferred the rewards and the risk associated with that investment to this what? A company. So this company cannot continue showing that as a financial asset in its statement of financial position. It has to be recognized. So therefore, in that case, we have those two criteria upon which the financial assets should be recognized. So next, we can look on the criteria for recognizing financial liability. Financial liability, basically, we have said this arises whereby a company has issued debt instrument, not investing, has issued. If a company issued debentures to company X, that is a financial liability because our company has an obligation to pay cash in form of interest, in form of principal amount. Now, a question arises, once the company has issued debentures, so when should the company recognize them, remove them? So we have one criteria, and that is when the entity's obligation to pay, when the entity's obligation to pay cash expires. When the entity's obligation to pay cash has expired, has done what? Expired. This company has issued debentures having a life of 3 years. At the end of the 3rd year, the obligation of the company to pay cash will expire because the company will redeem those particular debentures upon maturity. It basically means that once they have been redeemed, should the company continue showing them in the balance sheet as an uncurrent liability? No, they should be recognized. They should be what? Recognized. So these are basically the various criteria upon which financial assets and financial liabilities may be recognized. So there is a question, I think, which was on the past papers. We are going to look on that later on, which was asking about the criteria for recognizing financial liabilities. So those are the criteria you should be able to remember. And basically, when explaining these criteria for recognition, first of all, give the two criteria for recognizing a financial asset, and this one criteria for recognizing a financial what? A financial liability. So next, I want us to look on something known as the compound financial instrument. Compound financial instrument. This basically are abbreviated as CFI. CFI, compound financial instrument. So what do you mean by compound financial instrument? Now, compound financial instrument, these are the financial instrument. These are financial instrument which contains both equity and liability component. They contain both equity and the liability component. So what are good examples? Remember, generally, we have said that when we are referring to financial instruments, we are referring to things like shares, things like debentures. So we are saying compound financial instruments are those financial instruments. They contain both equity and liability component. Now, good examples of these examples include convertible securities. Convertible securities. Convertible securities are which securities? These include things like the convertible debentures, any security which is convertible, convertible bonds, convertible loan stock, convertible loan stock, etc. These are good examples of what? These are good examples of what? Of convertible securities. Now, why do we say that these convertible securities contain both equity and liability component? Why do we say start with part B, and it reads, discuss the significance of earnings per share in the analysis of the performance of a company. So here candidates were required to discuss, or in other terms to explain, the significance of earnings per share in the analysis of the performance of the company. So part B was requiring a candidate to explain significance of earnings per share, significance of earnings per share. So recall in our previous session, we talked about some of the benefits, or basically some of the significance of these earnings per share, which has to be computed, disclosed by all listed companies. And some of those particular significance, we said, number one, it can be used to evaluate a company's profitability. Profitability. So mean that the shareholders can use these earnings per share to know how the company generally is performing. Number two, it is used to compare financial performance of different entities within the same industry, within the same industry. So mean that the shareholders can use these earnings per share to compare performance of different companies within the same industry. And number three, we can say that it is used to compare financial performance of an entity in different years. So, and finally, we can say it is the basis. It is the basis of computing price earning ratio. It is used by the company in computing the price earning ratio. So therefore, these are basically some of the significance of earnings per share, and basically candidates by giving those particular significance or those importances of earnings per share, they were earning 4 marks. So let's move to part C, which involves some computation, and it reads, IAS 33 earnings per share set out the requirement for calculating and disclosing the basic earnings per share figure for quoted entities. The following information appeared in the consolidated income statement and other comprehensive income of 𝐉𝐨𝐬𝐧 Limited for the year which ended 31st of July 2018, together with the comparatives for the year which ended 31st of July 2018. So we are given the income statement and other comprehensive income for 2018-2017. We have profit before tax, income tax, profit after tax, other comprehensive income, which include revaluation gain on land. We have total comprehensive income, and then we have the profit for the year attributable to the owners of the group and attributable to non-controlling interest. We have total comprehensive income for the year attributable to the owners of the group and non-controlling interest. Then we are told the statement of financial position extract for the year which ended 31st of July 2018, together with the comparative for the year which ended 31st of July 2017, were as follows. So we are given those figures for 2018 and 2017. We have the equity share capital, 4% preference share capital share premium, other equity reserves, and controlling interest, retained earnings, and then we have the total equity. And then you're told during the year which ended 31st of July 2018, the following changes took place in relation to the issued share capital of 𝐉𝐨𝐬𝐧 Limited. Number one, you're told 100 million equity shares were issued in relation to the acquisition of another business. These shares were issued at full market price on 1st November 2017. Number two, we are told 150 million ordinary shares were issued for cash to existing shareholders on 1st February 2018. The issue price was the shillings 1.5 per share, which represent a discount of 25% on the traded price of shillings 2.0 per share immediately before the issue. Number 3, on 30th of June 2018, a bonus issue was completed by capitalizing shillings 135 million of the retained earnings. And 4, we are told on 31st of July 2018, the preference dividends for the year and equity dividends of shillings 23 were paid. So from this information, number 1, we are required to compute the basic earnings per share for 2 years, the year which ended 31st of July 2018 and the year which ended 31st of July 2018, 10 marks. And number 2, we are required to compute the comparative earnings per share for 2017 to be reported in the 2018 financial statement. And then in that case, we are told the earnings per share, the EPS figure reported in 2017 was 0.525 shillings. And in that case, the candidates were given to a mark. So let's start with the Roman 1 of that question, whereby the candidates were required to compute the basic earnings per share for 2 years. Basic earnings per share for 2 years. So Roman 1, basic earnings per share for the year which ended 31st of July 2017 and 31st of July 2018. So automatically we're going to start by computing the earnings per share for the first year. So therefore it is important first of all to note that the information which are given here, we're given information for 2 years, The first year ended on 31st of July 2017 and the second year ended 31st of July 2018. So let's start by computing the basic earnings per share for the first year. And for us to compute this basic earnings per share, the first thing we need to recall is the formula. How do we compute the basic earnings per share? How do we compute the basic earnings per share? So to compute the basic earnings per share, we take the PATOS, the profits attributable to ordinary shareholders, and then we divide that with the weighted average number of ordinary shares. So we divide that with the weighted average number of ordinary shares. So that is the first thing we need to remember. And therefore, having those or having the formula, we need to compute these two items. So let's start by computing the PATOS, which is the profit attributable to ordinary shareholders. So if you can be able to remember what we discussed in our previous session, we say that to compute this, the profit attributable to ordinary shareholders, popularly abbreviated as PATOS, popularly known as PATOS, we take the company's profit after tax. To this, we less the preference dividends for the current year. If we happen to be computing the earnings per share for a group of companies, to this we also less the profit attributable to the non-controlling interest. And actually, here we are computing earnings per share for a group of companies. That's what we are told in paragraph number 2. So in 2017, or we are given the profit after tax for 2017 is 240 million. That figure is already given at the paragraph 240 million. So to this, what do we need to do? To less the preference dividends. So how do we compute the preference dividends for this year? So to compute the preference dividends, we use the information where we are given the statement of financial position extract. And we are told that at the equity share capital, this company had issued 4% preference share capital, preference shares. So basically what that means is that this company at the end of each year should pay preference dividend equal to 4% of the preference share capital. The preference share capital for 2017 was 100 million. So 4% of that will give us 4. And then to this, we also less the profit for the year attributable to NCI. That is given in the income statement, which we have at the paragraph 2. we are given the profit for after tax attributable to the owners of the group and also attributable to non-controlling interest. So our interest here is the profit for the after tax attributable to the non-controlling interest, which is given as 30 million. So this will give us the profit attributable to the ordinary shareholder. So let's compute this. We see what it will give us. So we have 240 minus 4 minus 30. So this will give us 206 million. So this 206 is what we refer as the PATOS, the profit attributable to ordinary shareholders. So having computed that, then we need to proceed and we compute the one-offs, the weighted average number of ordinary shares. So recall what we said to compute this weighted average number of ordinary shares. So first of all, we need to determine how many ordinary shares were issued at the start of the year. And then to this, we add the other shares which were issued during the current financial year. And actually, you have to remember specifically how we treat the shares which were issued during the current year for the purpose of computing the one-offs. And take into account this year, the financial year of this company is ending July. So it means that the year is starting 1st August. So this year, therefore, started 1st of August of 2016. So what we need to do here is to determine how many shares were issued at the start of this year. And now all our figures here are in million of shillings, So if you check on the information which you are provided here, first of all, if we go to the additional information, number 1 up to note number 4, there is something we are told. Before note 1, we are told during the year which ended 31st of July 2018. That is the second year, because here we have 2 years. So that is the second year. So the year which ended 31st of July 2018, the following changes took place in relation to the issued share capital. So basically what that means is that the transactions we have in note 1 up to note 4, those are transactions for the second year. So therefore, as far as the first year here is concerned, we are not given any information regarding some shares which were issued in the first year. But if you go back to the statement of financial position, which we have just above the additional information, we are given the equity share capital of this company at the end of this year. So therefore, we can be able to determine the shares which were issued by the company at the end of year 1, the year which ended 31st of July 2017. Because how do we determine that? We take the equity share capital of the company at the end of the year. We divide that with par value per share. The par value per share, we have it there as 0.5. So what this will give us are the shares which were issued by the company at the end of the first year. So we have 200 divided by 0.5. So this will give us 400 million. So basically what that means is that in our case, we only know the shares which were issued at the end of the year. And take into account there is no transaction we are given regarding the shares which were issued during the first year, then in that case, we assume that there were no shares which were issued during this year, and therefore, the shares which were issued at the start of the year here will be the same with the shares issued at the end. We are not told during this year there were some shares which were issued. So basically what that means is that the shares which were issued at the start of the first year here were 400 million. And then in this case, we are saying that during the first year, there was no issue. There were no shares which were issued, because if there were any, then we come and we add them here. So basically what that means is that the weighted average number of ordinary shares for the first year will be how much? Or will be 400 million. So, and basically having those two figures, we can then proceed and compute the basic earnings per share, which will be equal to the PATOS, which we have here, 206 million. We divide that with the one-offs, which we have here, 400 million. And the answer which we get here, we give it as shillings per share. So let's divide those two figures. So we have 206 divided by 400 million, which will give us 0.515. So therefore, this is the earnings per share for that year. And generally, what is marked in such a question is this one, computation of that PATOS, and also the computation of what? Of the one-off. So therefore, that is first of all, what was required here as far as the computation of earnings per share for the first year is concerned. So let's then move and compute the basic earnings per share for the second year, which ended 31st of July 2018. Equally, in our case, we're using this formula here. Remember, here we are computing the basic earnings per share for that year. Basic earnings per share for the year which ended 31st of July 2018. We don't need to repeat our formula, but we need to know that to compute that basic earnings per share, this is the formula which we use here. So we need to compute the PATOS one-off for 2018. So let's start by computing the PATOS, the profit attributable to ordinary shareholders. The computation of this remains the same as what you have done here. So we start with what? The profit after tax. To this, we less the preference dividend, and also we less profits attributable to ordinary shareholders. So whatever you're going to get there will be our PATOS. So what is the profit after tax for 2018? So this is given as a figure of 325. So to this, we need to less the preference dividend. The preference dividend, we compute this using the information we have just above the additional information, because we have the preference share capital. So the preference shares issued by the company of 4% times the preference share capital for 2018. So actually, this one will not change. It remains, the preference dividend for that year remains 4 million, just like 2017. And then we less the profit attributable to NCI, which is given in the income statement up there. Profit after tax attributable to non-controlling interest, which is given as 45. So basically, by doing that, we get now the profit attributable to ordinary shareholders. So this will be a figure of what? 325 minus what? Minus 4 minus 45. Minus 45. So that will give us what? That will give us a figure of what? Of 276. So that is the PATOS. And then from there, we need to proceed and we compute the one-offs, weighted average number of ordinary shares. So to compute the weighted average number of ordinary shares, we have to take into account the shares which were issued, the ordinary shares issued and fully paid at the start of this year, plus the other shares which were issued during that year. So therefore, here what we start with are the shares which were issued at the start of the second year. Remember, this second year started on 1st of August 2017. So what we always start with here are the shares issued and fully paid at the start of the year. And basically, what we know is that the shares which were issued and fully paid at the end of the first year here will be the shares issued and fully paid at the start of the second year, are the shares issued and fully paid at the end of the second year here. So, and basically what we know is that the shares issued and fully paid at the end of the second year is now what we have computed here as 400,000. As 400 what? 400,000. So therefore, those are the shares which will be issued and fully paid at the start of the second year. And then now to this, we add the other shares which were issued in year 2. And actually, we're given those particular transactions in the additional information. Let's start with the additional information number 1, where we are told 100 million equity shares were issued in relation to acquisition of another business, and these shares were issued at full market price. So therefore, what we say here is that on 1st November 2017, we describe that particular transaction as issue at full market price. Now you have to recall what we said in our previous session, that such shares which are issued at full market price are supposed to be multiplied with the proportion of time they were held during that year. So basically these shares were issued from 1st November. So they were held for how many months? So they were held in November of 2017, December of 2017, and then how many months in 2018? 7 months in 2018, because you can see that here was ending July. So these shares were held for 9 months out of 12. So in that case, we say that those particular shares have been weighted on time basis, So we have 100 million times 9 divided by 12. So which will give us 75 million. So that's basically how we deal with such shares which are issued at full market price. Number 2, we are told 150 million ordinary shares were issued for cash to existing shareholders on 1st February of 2018. So, and we are told these shares were issued at a price of 1.5, which represent a discount of 25% to on the traded price of 2.0 per share immediately before the right issue. So in this case, there is this point, the examiner tried to trick the student because these are right issue, but the examiner did not clearly specify it is a right issue. So right issue has two features. Number 1, the shares always had issued to the existing shareholders. Is that feature there? Yes. Number 2 is that the shares, or during the right issue, the shares will be issued at a discounted price to the market price. Is that the case? Yes. So therefore, these are right issue, but the examiner here did not specify that, basically to try and catch most of the students. So you have to remember what we said in our previous session, that anytime the company has made a right issue, the shares which were issued must be split into 2 components. The shares issued at full market price and those shares which are issued at nil consideration. In this case, for us to do that, to split these shares into 2 components, we need to determine how many shares were issued during the right issue. Though in our case, we are told the shares issued during the right issue were 150. And number 2, we compute something known as the theoretical X-right price. So how do we compute this theoretical X-right price, like in our case here? Number 1, we need to determine how many shares were issued by the company during the right issue. And then we also have the shares which were issued by the company during the right issue. So what we need to do to determine the total shares issued by the company during the right issue, we can't get that in the question. We can only get it here. So, and in our case, we know that before this right issue was issued, these are the shares which were issued by the company. And the shares issued are not this plus this, because the actual shares which were issued here were not 75, but rather they were 100. So therefore, the shares issued by the company before the right issue will be 400 plus the actual shares here. That is 100. So that will give us 500. Those are the total shares which were issued by the company before the right issue. Before the right issue, the shares issued were 500 million shares, and they had a market price of how much? They had a market price of 2 shillings. And then during the right issue, the company issued 150 million shares at a price of 1.5. This will help us, or this basically how we compute what we refer to as the theoretical X-right price, the market price per share after the right issue. So we have 500 times 2, which will give us 1,000, and then 150 times 1.5, which will give us 225 million. So we add these two, and then we also add this, which will give us 650 million. So to get the theoretical X-right price, we take whatever we have here, because this is the total market price of all these shares, and then we divide that with 650, because in our case here, we're interested with the market price per share after the right issue. So this will give us shillings 1.88. So this is the market price per share after the right issue. And basically having that, then our question becomes very simple, because now what we just need to do is we split these shares into 2 components. So first of all, we need to determine the issue at full market price. How do we determine this? I gave you the formula in our previous session, and we said we compute the amount received during the right issue, which will be equal to the shares issued times the exercise price per share. So the existing shareholders were issued with the shares at a price of 1.5. So that will give us the amount received. Then we divide that with the theoretical exercise price, which is 1.88. And then these particular shares must be weighted on time basis. They must be multiplied with the proportion of time they were held. Remember, this right issue was made on 1st of February 2018. This how many months to the end of the year? We have February, March, April, May, June, July. So they were held for 6 months out of 12. And then 2, we determine the bonus element. The bonus element. How many shares were issued free of charge? To determine this, we said we take the total shares issued during the right issue minus the shares issued at full market price. The shares issued at full market price is not the answer which you're going to get here, but this is how we compute the shares issued at full market price. So we just transfer what we have here down here. So this will give us the shares issued at full market price, and equally these particular shares are not supposed to be weighted on time basis because they are shares issued at nil consideration. Let's first of all we compute this. 150 times 1.5 divided by 1.88 and then times 6 over 12, or basically divided by 2, which will give us 59.84. And then we compute this bonus element. 150 times 1.5 divided by 1.88, then deduct that from 150, which will give us 30.32. So basically that's how we deal with the right word issue. These are very common concept in all questions for earnings per share. So therefore, it is important for you to be able to deal with that word right issue. Finally, note number 3, we are told that on 30th of June 2018, this company made a bonus issue. So let's deal with that, or basically we consider that bonus issue, and we are told on 30th of June 2018, the company made a bonus issue. Bonus issue, remember, these are shares which are issued by the company free of charge. And actually, we are told the company made a bonus issue by capitalizing 135 million shillings of the retained earnings. It is important to note that whenever the company make a right issue, always the shares are issued at their par value. And therefore here, because you're given the total value of the shares which were issued during the right issue, we are told they had a value of 135. We need to determine how many shares were issued. How do we determine that? By dividing that with the par value per share. The par value per share is what we have in the statement of financial position, which is 0.5. That is the par value per share. That is how we compute the shares which were issued by the company during the right issue. So 135 divided by 0.5, which will give us 270. And also it is important to remember that these particular shares are not supposed to be weighted on time basis. And also we use them to restate the earnings per share for the previous year. So take into account in number 4, we are given information about dividends. We don't use that here. So what we need to do is we add all what we have here, so that we get what? The weighted average number of ordinary shares. So we have 400 plus 75 plus 59.84 plus 30.32 plus 270, which will give us 835.1 So that is the weighted average number of ordinary shares. And take into account we already have the PATOs. We need to proceed and we compute the basic earnings per share, which will be 276 divided by this. And this will give us what? So we have 276 divided by 835.16, which will give us shillings 0.33 per share. So basically that is it. That's what was required. And equally, what is marked in such a question is that computation of PATOS, and also this computation of what? The weighted average number of ordinary shares. So we are through with Roman 1. And then Roman 2, what we are required to do is we are required to compute the comparative earnings per share of 2017 to be reported in financial statement of 2018. In other terms, what the examiner was requiring the candidates there to compute is the restated or adjusted earnings per share over 2017. Remember, here we have 2 years. We have 2017 and 2018. And actually, we have said whenever you're given information about 2 years, 2017, 2018, and it happens that in 2018, the most recent financial, the company issued some shares free of charge or bonus shares, you have to use them to restate the earnings per share for 2017. So how do we compute this? We take the PATOS, the profit attributable to ordinary shareholders for 2017. We divide this with the weighted average number of ordinary shares, weighted average number of ordinary shares still for 2017. And then to this we add the bonus shares which were issued in 2018, So basically, in our case, the one-offs for 2017, what we computed, what we used to compute the earnings per share for 2017 was 400 million. And then can I be able to remember the figure for the PATOS? Yes, for the PATOS, it was 240 minus 4 minus 30. Yes, it was 206. That was the PATOS. And then to this, what do we need to add? We need to add the bonus shares issued in 2018. So where do we get that? From our computation here. In our computation, first of all, we have this bonus element, which is 30.32 million. And also we have this bonus issue of 270 million. So this is how we compute the restated or the adjusted earnings per share for 2017. So this, let's first of all, we compute the denominator 400 plus 270 plus 30.32, which will give us 700.32. So we have 206 divided by 700.32, so which will give us shillings 0.294. Yes, so basically that's how we compute that restated earnings per share for the year 2017. Basically, that is it. That what is required as far as that illustration is what is concerned. And actually, that brings us to the end of that session. So for now, is a bye. Welcome to this session, and in today's class I want us to discuss on this topic, which is one of the topics you should cover in this paper for advanced financial reporting and analysis, and also a very common topic in the exams. So in this topic you're going to discuss on like 4 main issues or 3 main issues. Number 1, you're going to define what is earnings per share. And number 2, we are going to look on the significance or basically the benefit of this earnings per share to the shareholders of the company. And then number 3, we're going to look on the various types of earnings per share which companies are expected or basically required to compute by this particular standard here, which is International Accounting Standard number 33. So therefore, those are the 3 main issues we are going to discuss. And to start with, we need to define what is earnings per share. So when talk about the earnings per share or the EPS, popularly known as the EPS, this refers to the amount of earnings or basically the amount of profit which is attributable to each equity or ordinary share which has been issued by the company, So therefore, we can say earnings per share is the amount of profit or amount of earnings attributable to each equity or ordinary share issued by the company, a company. So that is the definition of earnings per share. It is the amount of profit or basically earnings which is attributable to each equity or ordinary share which has been issued by the company. Now, all the listed companies or basically those particular companies whose shares are trading in the securities exchange market, they're required to compute two types of earnings per share in accordance with the International Accounting Standard number 33. So, and the two types of earnings per share to be computed by those listed companies, we have something called the basic earnings per share, popularly abbreviated as BEPS, and number two, we have the diluted earnings per share, abbreviated as what? The DEPS. So therefore, we can say that IAS 33 requires listed companies to compute and disclose, two earnings per share or two types of earnings per share, two types of EPS, namely, number one, basic earnings per share, abbreviated as BEPS, and number two, we have the diluted earnings per share, abbreviated as DEPS. So therefore, these are the two types of earnings per share which the listed companies are required to compute and disclose by the International Accounting Standard number 33. It is important to note that when talk about the listed companies here, we are referring to those particular companies whose shares trade in the securities exchange market. For example, in Kenya, we are looking at companies like Safaricom, companies like maybe Equity Bank, KCB, Kenya Commercial Bank, and so on. All these companies are listed because their shares trade in the securities exchange market. And basically, we are saying that those particular companies are required under International Accounting Standard number 33 to compute and also disclose as part of their notes two types of earnings per share. And this particular earnings per share basically is important to the shareholders of the company because the shareholders can use that particular earnings per share in various ways. And therefore, in this case, we can look on some of the significance or basically some of the importances of earnings per share. Number one, we can say that it is used by the shareholders of the company to evaluate the profitability of the company, profitability of the company, profitability of the company. So remember, in this case, we are saying earnings per share. It is basically amount of the profit or the amount of earnings generated by the company for each share which has been issued by the company. Therefore, this is like a profitability ratio, or basically it helps the shareholders to evaluate the profitability of the company. Number two is that this earnings per share is also used by the shareholders to evaluate, or basically we can say it's used by the shareholders of the company to compare. Let's talk about to compare the performance of the company in different years. It is used to compare performance of the company in different years. in different years. So mean that the shareholders of the company can use this earnings per share to compare the performance of company in different years. Number three, this earnings per share is also used to compare performance of different companies within the same industry, within same industry. Basically, what that means is that the shareholders of the company can use the earnings per share to compare performance of company A and company B if those two companies are within the same industry. And number four is that this particular earnings per share, we can say it is the basis. It is the basis of computing. It is the basis of computing. To this session, I want us to look on an illustration question regarding the computation of earnings per share. And specifically, I want us to look on this question for November 2018, specifically question number 5, B and C. So we start with part B, and it reads, discuss the significance of earnings per share in the analysis of the performance of a company. So here, candidates were required to discuss let's go through that particular question. We see what we are told and equally what the examiner was requiring. So the question reads, on 1st January 2023, 𝐷𝐶𝐻 Limited had in issue 43.2 million ordinary shares of shillings 10 par value and 12% convertible redeemable preference shares of shillings 10 par value each. The preference shares are convertible into ordinary shares on the basis of 80 ordinary shares for each shillings 100 of the preference shares for each of the preference share capital. 𝐷𝐶𝐻 Limited profit after tax from the continuing operation for the year ended 31st of December 2023 amounted to 201,600,000, and for the year which ended 31st of December 2022 was 97.2. And then you're told the average market price per ordinary share during the year which ended 31st of December 2023 was shillings 20. And then we are given some additional information about your told on 1st of April 2023, the company invited the current shareholders to subscribe for a rights issue on the basis of 2 new shares for every 3 shares held at concessionary price of shillings 15 per share, when the market value on rate basis was shillings 20 per share. Number 2, we are told on 1st of July 2023, 𝐷𝐶𝐻 Limited issued 36 million ordinary shares at a full market price. Number 3, we are told on 1st September 2023, the company made 143 bonus issue of ordinary shares using the share premium account. Number 4, on 1st of October 2023, holders of shillings 80 million 12% convertible preference shares exercise their conversion right. So what are we required to do from this information? 1, we're required to calculate the basic earnings per share for the year which ended 31st of December 2023, 6 months. Number 2, we're required to calculate the restated earnings per share for the year which ended 31st of December 2022. And number 3, we are required to calculate the diluted earnings per share (DEPS) for the year which ended 31st of December 2023. Automatically, we're going to start with Roman 1 of that particular question. And in Roman 1, we are required to compute the BEPS, basic earnings per share, for the year which ended 31st of December 2023. The basic earnings per share for the year which ended 31st of December 2023. Remember, in our case, we said for you to compute this basic earnings per share, you must have the formula. How do we compute this? We said we take the PATOS divided that with 1/0. So we need to compute these two values here. The profit attributable to ordinary shareholders, abbreviated as PATOS, and the weighted average number of ordinary shares, abbreviated as what? 1/0. So let's start by computing this one. And the PATOS, we said, how do we compute this one? We take the profit for the year, which is also known as net income, which is also known as the profit after tax. So to this, we left what? We left the preference dividends, for the current year. In case we are computing the earnings per share for a group of companies, we left what? To this, we left the profit attributable to the non-controlling interest to the NCI. And also to this, we said we add any loss from discontinued operation, loss from the discontinued operations, loss from discontinued operation. That's basically how we compute that profit attributable to ordinary shareholders. So I want us to just plug in those figures, having that format of computing the PATOS. Now, where do we have the profit after tax for this year, for the year 2023? That information, we have it within paragraph 1 of the question. Within paragraph 1, I think in paragraph 1, the last sentence. Can we go to the last sentence of paragraph 1? We are told 𝐷𝐶𝐻 Limited profit after tax from the continuing operations for the year which ended 31st of December 2023 amounted to 201,600,000, and for the year which ended 31st of December 2022 was 97.2. So in our case, we are given this profit for the year, or the profit after tax for 2023, as an amount of 201. 600,000, and basically you're told that this particular profit is from the continuing operation. So being the profit from the continuing operation, it basically means that there is no profit, or basically there is no loss from the discontinued operation which has been included here. This particular profit of 201,600,000 does not include any profit or loss from discontinued operation. And basically it means that in our case here, this adjustment will not be included here because we are given the profit after tax from the continuing operations. Remember, in this case, I said a discontinued operation is a component of an entity which has been discontinued. For example, a company had a number of branches, but because one of the branches has been making losses, it has been closed down. It is a discontinued operation. In case of a parent company may be having various subsidiaries, and because one of the subsidiaries is making losses, that subsidiary has been disposed, has been sold by the parent company. It is a discontinued operation. So we said in computation of both the basic and also diluted earnings per share, we totally exclude any profit or loss from discontinued operation. We only use the profit or loss from the continuing operation. So meaning that in this case, we don't have any loss because this pure profit from continuing operations. Then in this case, we need to check whether this company had issued preference shares. Well, there are some preference shares which were issued. But also there is something which you said is very, very important, and you must remember that throughout. In case the company had issued preference shares, and the preference shares issued by the company, they are redeemable, we said never make a mistake of deducting their dividends here, because we said redeemable preference shares, this to the company is like a debt capital, because these are preference shares once issued by the company has to redeem them back. So this is like a debt capital. And therefore, we say the dividends in relation to the redeemable preference shares, those dividends are basically classified as part of the finance cost, And therefore, in arriving at this particular profit, which we have here, all expenses, including the finance cost, have been what? Deducted. So in case the preference shares issued by the company are redeemable, don't less their dividends there. Yes. Now, in our question in paragraph 1, specifically sentence 1, we are told on 1st January 2023, which is basically at the start of the current year, 𝐷𝐶𝑠 Limited had initial 43.2 million ordinary shares of �10 par value and 12% convertible redeemable preference shares of �10 par value. Now, who can tell us? Are we going to less the preference dividends for those preference shares here? Yes or no? Are we going to less the dividends for those preference shares here? Are we going to less them here? Are we going to less them here? Yes or no? Automatically no. Automatically no. Reason being, those preference shares, you can see they are redeemable. They are what? Redeemable. So if they are redeemable, their dividends were included as part of the finance cost. Finance cost, we know, is an expense, which is one of the expenses which has already been deducted in arriving at that word profit. So in that case, we will not less those particular those dividends there. Then in this case, we are not dealing with a group of companies. This is a single company. So meaning that here equally we don't have any profit attributable to the NCI. We don't have profit attributable to the NCI. So the PATOS, the profit attributable to ordinary shareholders, therefore, remain the same, 201,600,000. So we already have the PATOS. Then we need to move and compute the one-offs. The weighted average number of ordinary shares. How do we compute this one? We say to compute this, we take into account the ordinary shares which had been issued at the start. Automatically, this year started on 1st of January 2023 and basically ended on 31st of December 2023. So how many ordinary shares had been issued by the company at the start? And then we add the other shares which were issued during that year. So therefore, we start with the shares which had been issued, the number of ordinary shares which had been issued at the start of the year. And basically, we refer to this as the balance brought down. The balance brought down. So the shares which were issued, the ordinary shares which were issued by the company to the start of the year, we have this within paragraph 1. Within paragraph 1, sentence 1, we are told on 1st January 2023, 𝐷𝐿𝐼 Limited had in issue 43.2 million ordinary shares of shillings 10. These are the shares which in other terms had been issued by the company at the start of the year, 43.2 million. And it's very, very important for you to check whatever you're given here, whether this is the share capital or whether these are the number of shares. If you check 43.2, these are ordinary shares. But if, for example, we are told the company had a share capital of 43.2 shilling, 43.2, then take into account we have the word shilling, automatically this would not be the shares, but this would be the value of the shares. To determine the number of shares, you take this amount, you divide that with the par value of 10. But in our case, you can see 43.2 are the number of shares, Because this is basically another area whereby the examiner will try to catch you. Instead of giving you the number of shares issued, he will give you the share capital. Shillings, like in this case, we are told shillings 43.2, which would not be the shares, but the share capital. For you to get the shares, divide that with the par value. So we are done with that. And then the transactions which took place during the current year for the issue of shares, that is something which is given in the additional information, note 1, note 2, 3, and 4. So can we go to note number 1? In note number 1, you're told on 1st of April 2023, the company invited the current ordinary shareholders to subscribe for a rights issue on the basis of 2 shares for every 3 shares held at concessionary price of shillings 15, shillings 15, when the market price on the CAMRIGHT basis was shillings 20. So basically, we are told on 1st of April 2023, the company invited the current shareholders to subscribe for something called the right issue. I hope you can see this particular concept of right issue. This is something we have come across in all questions. This is the 3rd question we are doing, and all the questions we have done, we have come across that concept of the right issue. Because I say this is one of the concepts majority of the students will get it wrong. That's why you can see it is tested in almost all questions for earnings per share. Now, what we say is that a right issue is basically whereby the company issue additional shares to the existing shareholders of the company, but basically at a price below the market price. Therefore, we say these shares which were issued during the right issue, one, we have to split them into 2 components: shares issued at full market price and the bonus element. Then from there, or basically for us to be able to do that, we have to compute 2 items: how many shares were issued during the right issue, and we also compute a price which is known as the theoretical exit price. So can we compute those 2 items? I want us to compute those two items. One, we start by computing how many shares were issued by the company during the right issue, and then we compute the theoretical exit price. So for us to be able to compute the shares which were issued during the right issue, we have to go back to note 1, and you're told the company invited the current shareholders to subscribe for the right issue on the basis of 2 new shares. The basis of 2 new shares, for every 3 shares which were held. For every 3 shares which were held. So what we need to do here is basically we determine how many shares were held before the right issue. Who can tell us? The shares held before the right issue, we said that one you can't get it in the question. The shares which were held before the right issue is basically what we have here. Is what we have there, 43.2. So the shares which were held before the right issue are 43.2 million shares. So therefore, because the company was to issue 2 shares for every 3 shares which were held, we need to determine how many shares were then issued. Cross multiply, then we divide 2 times 43.2 million divided by 3. Divided that with 3. That will give us how many shares? The shares which were issued during the right issue. The shares which were issued during the right issue. I'm given 28.8. 28.8 million. That is the answer I'm getting from Gilbert, from Mercy, and the rest getting the same 28.8 0.8. Okay, so having that, then we need to proceed and we compute something called the theoretical exit price. Theoretical exit price, we said this is the expected market price per share after the right issue. We say to compute this is quite simple. We need first of all to determine how many shares were issued during the how many shares had been issued before the right issue, and what was the market price per share before the right issue. And then from there, we take into account the shares which were issued during the right issue and the issue price. For example, in our case, we know during the right issue, the shares which were issued by the company are this, 28.8 million. So these are the shares which were issued. And each share was to be issued at a price of what? During the right issue, each share was to be issued at a price of what? As per note number 1. As per note number 1, each share was to be issued at a concessionary price of shillings 15. Each share here was to be issued at a price of 15. Then how many shares were held before? The shares which were held before the right issue is what we have here, 43.2 million. And also as per note number 1, we are told that we are given the market price of each share before the right issue. What is the market price of each share before the right issue? The market price of each share before the right issue was how much? Yes, it was 20. It was 20. So having that, then we can proceed and compute the theoretical exit price. First of all, we need to multiply this. So 43.2 multiplied by 20. So this, I'm told, will give us 864 million. What about the other one here? 432 million. 432, is that what you're getting? Yes, if that is what you're getting, then we need to get this total. We need to get the totals here. This plus this, which will give us what? Which will give us 72 million. What is the market capitalization? The total market value of those shares. Market capitalization. Market capitalization, I'm told by medium here, will be 12.96 million. So meaning that after the right issue, the company will have issued 72 million ordinary shares, which will be having a total market price of 12.96 million. So what we want to do is basically to determine what will be the market price of one share after the right issue. For us to do that, to determine the theoretical exit price, we take this amount here, 12.96 million, divided that with 72 million shares. 72 million shares. This will give us a theoretical exit price of shillings 18. Remember, I said always, the computation of that has a mark. The computation of theoretical exit price, there is some marks which is allocated to that. So let's come back here, and we need to split these shares into the two components. We start by computing the shares which were issued at full market price. Issue at full market price. At full market price. How do we compute this one? You just need to record the formula. So first of all, compute the amount which was received. The amount received will be equal to the shares which were issued during the right issue. And these are the shares which were issued during the right issue. 28.8 million times the issue price. Each share was to be issued at a price of, or was issued at a price of 15. And then we divide that with the theoretical exit price, which you have computed there, 18. And then we say these shares always are weighted on time basis. We multiply them with the proportion of time they were held. These shares were held from April to December. So remember, the year is ending December. So here we are only excluding how many months? 3. We're excluding January, February, and March. So the remaining months are 9. So meaning that these shares were held for 9 months out of 12. So then from there we compute the bonus element. The bonus element. So bonus element, the shares which were issued free of charge. How do we compute this one? We take the total shares which were issued during the right issue, 28.8 million. minus the shares issued at full market price. We say the shares issued at, but basically these are the shares which were issued at full market price before multiplying that with the proportion of time. So we say just transfer that down here. 28.8 million times 15 divided by 18. And then we say that these shares should not be weighted on time basis. So give me the answer here. The shares which were issued at a full market price. At full market price. 18 million. 18 million, is that what you're getting?
However, we have
yes, what are you getting here? Yes, I'm given 18 million. I'm given 18 million. What about the issue at nil consideration, the bonus element? Yes, in this case, that will give us a 4.8, 4.8. 4.8. So that's basically how we deal with that particular right issue. I want us to move to the other transaction. The other transaction, note number 2. We are told on 1st July 2023, 𝐷𝐨𝐺 Limited issued 36 million ordinary shares at full market price. That one is quite simple. So we will say, we first of all write the date, 1st July 2023. We will say there was issue at full market price. So we say the shares issued at full market price just need to be weighted on time basis. We take the shares which were issued, and the shares which were issued were 36 million, and then we multiply them with the proportion of time they were held. So these shares were held from July. From July to December, how many months do we have? We automatically have how many months? 6 months. 6 months. So 6 months. So half of this is what? Is 18 million. Half of that is 18 million. Half of that is 18 million. So we are done with that. And then let's move to the other point here. And you're told on 1st September 2023, the company made 1-for-3 bonus issue of ordinary shares using the share premium account. So on that date, there was a bonus issue on 1st of September 2023. So in this case, we are told the company made a bonus what? Made a bonus issue. And we are told this bonus issue was 1-for-3. 1-for-3. 1-for-3, we said the first thing you must be in a position to do is to interpret what you mean by that. 1-for-3. 1-for-3 means that during this bonus issue, the company was to issue 1 share. The company was to issue 1 share for every 3 shares. For every 3 shares which were held. That is the first thing you must be in a position to do, to interpret that 1-for-3 bonus issue or bonus share. So then from there, having that ratio, we need to determine how many shares were held before this bonus issue. How many shares were held? So we say to determine the shares which were held, you can't add all this. You can't add this, and then simply because some of the shares have been weighted on time basis. You must determine the actual shares issued on this date. The actual shares which were issued, we take these ones. The shares which had been issued here were 43.2 million. And then how many shares were issued during the right issue? During the right issue, can tell us how many shares were issued? That is what we consider. We don't consider this and this. We consider the actual shares issued during the right issue. During the right issue, how many shares were issued? The actual shares which were issued during the right issue are this. Don't consider this and this. Take the actual shares. They were 28.8 million. And then how many shares were issued here? The shares issued here were not 18, but rather 36 million. So that's basically how you determine the shares which were issued before the bonus issue. The actual shares issued here, the actual shares issued during the right issue, the actual shares issued here at full market price. And this will give us what? This will give us 72 plus 36, which is giving us 108 million, 108 million, 108 million. Is that what you're getting? 108 million. Yes, 108 million. So therefore, the shares which were held before the right issue, before the bonus issue were 108. So basically what we need to do is we cross multiply, then we divide. So let's have the computation here. So we have 1 times 108 million divided by 3. Divided by 3. This will give us what? This will give us 36 million. And then you have to recall that these particular shares are not weighted on time basis. We don't weight them on time basis. Those shares should not be weighted on time basis because they are shares issued at nil consideration. In the last point, number 4, we are told, on 1st of October 2023, holders of shillings 80 million 12% convertible preference shares exercise their conversion rights. In that case, we are told on 1st of October 2023, there was conversion. There was what? A conversion of 12% convertible preference shares. In other terms, what that means is that preference shares which had a value of 80 million were converted into ordinary shares. In this case, what do we need to do? We need to determine the number of ordinary shares which were issued on conversion. How many ordinary shares were issued here on conversion? For us to be able to do that, we must have the conversion rate. The rate at which those particular convertible preference shares are converted into ordinary shares. Where do we have that conversion rate? The conversion rate is given within paragraph 1. Is given within paragraph 1, sentence 2. And you go to paragraph 1, sentence 2, and you're told the preference shares are convertible into ordinary shares on the basis of, that is what we need, on the basis of 80 ordinary shares, the basis of 80 ordinary shares for each shillings 100, for each shillings 100 shillings 100 of the preference share capital. Preference share capital. So preference share capital having a value of 100 will be converted into how many ordinary shares will be converted into 80 ordinary shares. Now let's go back to the last point, which is point number 4, whereby we are told the preference share capital which was converted into ordinary shares was a preference share capital having a value of 80 million. 80 million. Yes. So what we just need to do here is we cross multiply, then we divide. So, and we determine how many ordinary shares were issued on conversion. So we take 80 times 80 million. 80 million. We divide that with what? With 100. With 100. And then in this case, recall we say that those particular shares, those ordinary shares which are issued on conversion, we treat them as an equivalent of shares issued at full market price. These shares must be weighted on time basis. We must multiply this with the proportion of time they were held. They were held for how many months? October, November, December. October, November, December. They were held for 3 months out of 12. 3 months out of 12. That will give us what now? That will give us what? I'm told it will give us 16 million, 16 billion. Yes. And basically in our case, we are done. So what we need to do is now we compute the 𝐵𝐺, not the 𝐵𝐺, we compute the one-offs, weighted average number of ordinary shares, basically by adding all this. We add all that. So we have 43.2 plus 18 plus this 4.8. 4.8 plus 18 plus 36 plus 16. So, and I'm getting a figure here of 136 million. 136 million. Is that what you're getting, 136 million? Being our one-offs, weighted average number of ordinary shares. Is that what you're getting? Is that what you're getting? Yes. So having that, then finally we need to compute the basic earnings per share by applying our formula here. So we take the 𝐵𝐺, our basic earnings per share will be equal to 𝐵𝐺, which is this one, 201,600,000, divided that with what? With one-offs, which is 136 million. So what do we get here? The answer will be in shillings per share. Shillings per share. 1.482 shillings, 1.482 shillings per what? Per share, yes. So basically that is the answer I'm getting from Gilbert, from Diana. I hope that is correct. I hope that is correct. Is that correct? Is that correct? Yes, it has been confirmed by Patrice. So that is it. That basically what is required. So the marks are located there 6. So the items which are marked, first of all, is basically computation of 𝐵𝐺. There must be a mark for that. And basically these figures now here. These figures there. Yes, those are the figures which are marked. And basically you get now the 6 marks. So let's move to Roman 2. We move to Roman 2 of that question. Roman 2. Roman 2. So in Roman 2, what are we required to do here? Roman 2. In case of any question, type it in the chat box. I'll be able to see it. In case you have a question, type it in the chat box. In Roman 2, we are required to compute the restated earnings per share for the year 2022. This the restated earnings per share for the previous year. In other terms, recall we refer to this as what? As the adjusted earnings per share for the year which ended 31st of December 2023. Now, if you can be able to recall, we say that the earnings per share for the previous year is always restated as a result of issue of shares during the current year free of charge. We said if there are some shares which were issued during the current year at nil consideration of free of charge, we have to use those shares to restate, to adjust the earnings per share for the previous year. Reason being, or basically what we say is that assuming you're given 2 years, right? In our case, we have 2 years, 2023 and 2024. So we say that if during the current year, which is the year 2023, the company issued shares at nil consideration. These are the shares which are issued free of charge. Those shares are assumed to have been issued at the start of this year. But basically, we know when the company was computing the earnings per share for this year, 2022, those shares were not used. And that's why we say those shares which were issued during the current year, we have to use them to restate the earnings per share for the previous year. How do we compute this restated or adjusted earnings per share for this year? We said we take the 𝐵𝐺 for this year, which is 2022. We divide that with what? We divide that with one-offs, equally for 2022 this year. And then now to this one also we add what? The bonus shares, which were issued in the year 2023. The shares which were issued for free during that what? That year. That is a formula which we use to compute the restated earnings per share for the previous year. Now, we need to have this PATOS. And basically, from what we have done in the year 2023, I hope you can remember we have said that this PATOS is equivalent to the profit for the year. That's what we have said. Because we don't have profit attributable to NCI, the preference dividends we have said do not be deducted from this profit, simply because the preference shares issued by the company are redeemable. And equally, we have said we don't have any loss or profit from discontinued operation. And therefore, going back to the information we have in paragraph 1, we are given the profit after tax for 2022. That profit after tax for 2022, we are saying, will be the same with the PATOS. Will be the same with what? PATOS. So how much is the profit for 2022? As per the first paragraph, the last sentence. The first paragraph, the last sentence. Who can be able to see that figure? The first paragraph, the last sentence. The profit after tax for 2022, 97.2. 97.2. 0.2 like that. 0.2 like that. Then, if you check on this particular question here, there is nowhere we are given information about the shares which were issued by the company in 2022. Is there anywhere we are given information about the shares which were issued by the company in 2022? Because that's what we need to use in computing this. Yes or no? If you check on basically like in the additional information number 1 up to note 4 is about the transaction for the current year. Note 1 is about information about the profit for the year and the shares which had been issued at the start. But in this case, it is important for you to note that once you're given information about 2 years, like in our case, we have 2023, 2022. So we are given information about the shares which had been issued at the start of this year. Can you remember those shares which had been issued at the start of 2023? They were 43.2. 43.2 million. Those are the shares which had been issued at the start of this year. Automatically, that is the opening balance in 2023. In 2022, it was the closing balance. And therefore, in this case, we can say at the end of 2022, these are the shares which had been issued. And because we are not given any information about the shares which were issued in 2022, in this case, then the shares which had been issued at the start of 2022 remain the same, 43.2. There is no transaction given about the shares which were issued in 2022. So it basically means that the shares which were issued at the start, at the end, will be the same with the shares issued at the start of the year. And if that is the case, the shares issued at the start and the shares issued at the end of the year are the same, then this is always your one-offs. This is always your what? Your one-offs. Because like in this case, we are saying the shares which were issued there for 3.2, there were no other shares. The one-offs will remain the same. So therefore, the one-offs for 2022 is 43.2. 43.2. And then now to this one-off for 2022, we need to add the bonus shares which were issued in 2023 during this year. So from our computation here, there are a number of shares which were issued free of charge. One, we have this bonus element in the right issue, which is 4.8. 4.8. And also we have what else? What else do we have? We have this bonus issue. This bonus issue here. These are other shares which were issued free of charge. So we also consider them here. They are 36 million. 36 what? 36 million. So that is basically how we compute the adjusted or the restated earnings per share for the previous year. For the previous year. So give me the final answer here. Give me the final answer. Give me the final answer here. the final answer, 1.157 shillings per share. Is that what you're getting? 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 Okay, so if you're getting that, I want us to do the last part of this question now. Let's move to Roman 3. We move to Roman 3 of that question. Roman 3. Roman 3. Roman 3, and basically Roman 3, what are we required to do? We are required to compute the diluted earnings per share. Roman 3, we are required to compute the diluted earnings per share for the year which ended 31st of December 2023. Recall what we said in our previous class. For you to compute this diluted earnings per share, you need to follow 3 basic simple steps. 1, you need to go back to the information which are given by the examiner here, and basically you identify the potential ordinary shares which the company had issued in the year under consideration. For example, in this case, you need to determine in the year 2023, was the company having any potential ordinary share? And actually, we said potential ordinary shares. You'll be checking whether the company had issued any convertible security, any share, or basically any preference share or any other debt instrument which is convertible into ordinary shares, and also whether the company had granted the employees some stock options. So once you have identified those potential ordinary shares which the company had in the year under consideration, step 2 is you compute increase in earnings, increase in number of shares, and finally you compute the diluted earnings per share. Those are the 3 basic steps to be followed in computation of this. So therefore, the first thing we need to do is we go back to the question, to the information which are given here. We check whether the company had any potential ordinary share or basically shares during the year 2023. So in this case, I've said we will check whether the company had issued any convertible security or any convertible preference share, and whether the company had granted the employees a stock or a share option. So from the information which are given in this particular question, which were the potential ordinary shares which our company had, or which the company had in the year 2023? Any potential ordinary share? Any potential ordinary share during this year? So 1, the company had not granted the employee stock option. Number 2, I can't see any convertible debt instrument. So the only convertible instrument which we have is what you're given in paragraph 1. The preference shares which were issued by the company are convertible. Are what? Are convertible. So we only have one. That is the convertible preference shares. Convertible preference shares. Convertible preference shares. Now, having this, what we need to do is basically we proceed and we compute 2 items: increase in earnings and basically increase in number of shares. But equally, before we do that, there is some analysis which we need to do here. There is some analysis we need to do here. There is some analysis we need to do here. Now, let's go back to the information we have in paragraph 1. In paragraph 1, we know that the financial of this company started 1st January 2023 and basically ended on 31st December 2023. As per the information we have in note 1, the preference shares which have been issued by the company at the start of the year as per paragraph 1, they were 12 million preference shares, and each preference share had a par value of 10. So meaning that the total preference share capital at the start was 120 million. That is the preference share capital of the company at the start of the year. Then, can we go to note number 4? In note number 4, we are told on 1st of October 2023. This is basically 3 months to the end of the year. We have October, November, December. So meaning that here we have 9 months. So we are told shillings 80, or holders of shillings 80 million convertible preference shares, converted them into ordinary shares. So preference shares which are the value of 80 million were converted into ordinary shares. So what is the balance? The balance will be 120 minus 80. So the balance of the ones which were not converted had basically a value of what? Had a value of 40 million, sorry. 40 million. Is that the case? Yes, 40 million. So that information is very, very important, specifically in computation of this, just like the other question which we did. And who can be able to remind us here? How do we compute this increase in earnings for the preference shares? This is something we discussed on Thursday. Is it what, Thursday or Wednesday? Wednesday. How do we compute the increase in earnings for preference shares? For preference shares, I'm told by Gilbert is interest paid minus tax rate. Is that how we compute that? Preference shares, does the company pay, if the company has issued preference shares, does the company pay interest? Does the company pay interest? No. If the preference shares are issued by the company, if the company has issued preference shares, the company does not pay interest. The company does not pay interest. The company pays something called what? The preference dividend. The preference what? Dividend. Rudy is saying zero. Apana. Apana. So I think we had that discussion on how we compute the increase in earnings. The increase in earnings for the preference shares, I think I gave you this. We said this one is always equal to the preference dividends, which one were paid. The preference dividends which were paid. And actually, in this case, we said that for this dividend, we don't multiply them with 1 minus tax rate, because we know in taxation, dividends, they are not allowable expense. They are not allowable expense. So therefore, the increase in earnings is equal to the preference dividends which were paid. But it's also important for you to note that preference shares, especially the redeemable ones, they are equivalent to the debt instrument. For example, the holders of the preference shares who converted them into ordinary shares, they were only paid dividends for the first 9 months. They were not paid dividends for the last 3 months because they had converted them into ordinary shares. So therefore, we need to compute how much preference dividends were paid during this year. We first of all compute the preference dividends which were paid for the first 9 months, which will be equal to the rate of preference dividends. And the rate is what? The rate of preference dividends. This preference dividends issued by the company, the year rate is what? The year rate is 12%. 12%. So we take 12% times 120 million, and then that will apply for 9 months out of 12. And then we do the same for the last 3 months. We take 12% times the preference shares which were not converted times 3 out of 12. 3 out of 12. In this case, we don't multiply that with 1 minus tax rate. We don't multiply that with 1 minus tax rate. We don't multiply that with 1 minus tax rate. So how did we get 120 million? 120 million is, I think I've noted that here. Maureen. The preference shares issued, this one is in paragraph 1, first sentence. First sentence, the preference shares which have been issued by the company were 12 million times the par value for each, which will give us 120. 120. The other, there is still another alternative, or basically another way you can compute this. There is still another option you can use, or another way you can compute this. You can take the preference dividends which was supposed to be paid for the whole year. The preference dividend which was supposed to be paid for the whole year will be 12% of 120 million. 12% of what? 120 million. But basically, we know that on this date, preference shares which had a value of 80 million were converted into ordinary shares. So meaning that the holders of these preference shares having a value of 8 million will not be paid dividends for these 3 months. So what you do, out of these dividends which are supposed to be paid for the whole year, you less the dividends which were not paid here. The dividends which were not paid will be dividends for equal to 80% of 80 million. Because once you convert your preference shares into ordinary shares, you can't continue receiving preference dividends. So the holders of these preference shares were not paid dividends for the last 3 months. You less that amount here, because this will give you the preference dividend for the whole year minus the dividends which were not paid for the last 3 months. 12% of 80 times 3 out of 12. And basically, you should get the same value. You should get the same value. Whether you use that, whether you use that, you can confirm that for me. Are you getting the same answer? You should get the same answer. You should get the same answer here. Are you getting the same answer? Are you getting the same answer? Are you getting the same answer? You should get the same. You should get the same. You should get the same. Should get the same. Yes. I think that one has been confirmed. Okay. So let's move and then we compute the increase. The increase in number of shares. Increase in number of shares. Increase in number of shares, the first thing we must have here is basically the conversion rate. The conversion rate. The conversion rate, we have it within paragraph 1. Within paragraph 1. And paragraph 1, sentence 2. Paragraph 1, sentence 2, we are told the preference shares are convertible into ordinary shares on the basis of 80 ordinary shares for preference shares having a value of 100. Preference shares having a value of what? Of 100. So in our case, we know that for the first 9 months, the preference shares which had been issued, they had a value of 120 million. So this basically will apply for 9 months. For 9 months. And then basically we need to multiply, cross multiply, then we divide. For the last 3 months, so we can equally have the conversion rate, 80 ordinary shares. And the company is supposed to issue 80 ordinary shares for preference shares having a value of 100. And basically for the last 3 months, the preference shares which had been issued had a value of 40 million. This will apply for the last 3 months. So we cross multiply, then we divide. So we work out this. We start with the first 9 months. We take 80 times 120 million divided by 100 times 9 all over 12, because that is only applying for 9 months. And then for the last 3 months, we take 80 times 40 million divided by 100 times 3 out of 12. 3 out of 12. So we get the final answer here. Yes, so give me the answer so that we weigh that. So what are you getting here? What are you getting? What are you getting? I'm waiting for the final answer there. Remember this 120 million. This 120 million. Yes, in this case, I'm given 80 million, 80 million. So having that, then we need to finally compute the diluted earnings per share, the DEPS, which is equal to PATOS, divided that with 1/0. And then to this, we add increase in earnings. To this, we add increase in number of shares. To this, we add increase in number of shares. Remember, this is the diluted earnings per share for the year 2023. So meaning that we need to have the PATOS and 1/0 for 2023. The PATOS and 1/0 for 2023. So the PATOS, I can remember it was 201. It was 201 what? 201 600. 600. 1/0 was it 136 million? 136 million, yes. So and then to this PATOS, we add the increase in earnings. The increase in earnings is what you have computed here, 120 million. And then to this, we add increase in number of shares, which is 80 million. So this will give us what? Uh, 12 million. Okay, so this one I'm told is 12 million. Is 12 million on 120. Yes, so I'm given by Diana 0.989 shillings per share. Shillings per share. Is that what you're getting? Is that what you're getting? Is that what you're getting? EVF, please confirm. Is that what you're getting? Is that what you're getting? Yes, yes, yes. Okay, so basically that is it. That what was required as far as that question there is what is concerned. I'm trying to see whether we can get another question here. Yes, so can you have this question as we come back, as we take a short break and then come back, we see whether we'll be able to finish. So April 2022, which is the question number 3C. 3C, you have that question. That question there. We take a short break of 5 minutes, just a short breather of 5 minutes, and then we come back to look on that question. So see you after the short break of 5 minutes. Yes, so what are we told in this particular question here? So it reads, 𝑅 Limited, a publicly traded company, had 9 million ordinary shares of shillings 1 par value and 1 million 7% redeemable preference shares of shillings 10 par value each on 1st of October 2020. As at that date, 𝐷 had also in issue a 2.5 million stock option. This option are exercisable at shillings 15 per share. And then you show the average fair value per ordinary share during the year which ended 30th of September 2021 was shillings 2. Then from there, we also have the other paragraph, and we are told unlimited a profit for the year to 30th of September 2021 from the continuing operations was 14,575,000, and for the year which ended 30th September 2020 was 15.1 million. Then we are told the following transactions took place during the year which ended 30th of September 2021. So basically, you given those transactions, note 1, 2, 3, 4. What are we required to do here? In Roman 1, we are required to compute the basic earnings per share for the year which ended 30th September 2021. Roman 2, the restated earnings per share for the year 2020, and Roman 3, the diluted earnings per share. So we start with the Roman 1, basic earnings per share for the year which ended 30th of September 2021. So we will try to move at a speed because of time. So in this case, we have said to compute this one, we take the pathos, divided that with what? With one-offs. Pathos divided with one-offs. We start by computing pathos here. We start by computing pathos, which we have said is equal to a profit after tax or the net income. Net income. To this, what do we less? We less the preference dividends for the current year. In case we are computing EPS for a group of company, we less the profit attributable to NCI. And in case we are told this profit include a loss from discontinued operation, we add it here. Loss from discontinued operations. That's basically how we compute that one. So let's go back to the information which are given here. And in paragraph number 3, we are told unlimited profit for the year, which ended 31st of December 2021 from the continuing operation. From the continuing operations was 14,575,000. Remember, that is basically the profit after tax for the year 2020. We are computing the basic earnings per share for 2021. 2020. Yes, actually that is for 2021 because now what you're given inside the brackets is for 2020. So meaning that the profit for the year was how much? Was 14,575,000. So then from there we need to check whether this company had issued preference shares. And we have that information within paragraph 1. Within paragraph 1, you're told 𝐷 Limited, a publicly traded company, had 9 million ordinary shares of shillings 1 par value and 1 million 7% redeemable preference shares. In this case, you can see the preference shares issued by this company were redeemable. So if they were redeemable, we have said those dividends should not less their dividends here because they were included as part of the finance cost in arriving at this profit for the year. They have already been deducted. Okay. Then in this case here, we are not computing earnings per share for a group of companies. This is a single company. 𝐷 Limited is a single company. And then from there, we are also told that this particular profit which are given here is actually from the continuing operation. So no profit or loss from discontinued operation has been included here. It basically means that the pathos is how much? Is 14,575,000. 14,575,000. So having that, we need to move and basically we compute the weighted average number of ordinary shares. So how do we compute this one? By taking into account the shares which had been issued at the start of the year plus the other shares. And I hope you can see when the year was ending. The financial year ended 30th of September 2021. So it is obvious that this year started on 1st of October because The next year will start 1st of October, but of 2020. So that is when the year started. So this year started 1st of October 2020. So we need to determine how many ordinary shares had been issued by the company at the start of the year here, on this date, on that date. Which information are we given about that? If we go back to paragraph 1 of this question, we are told R Limited, a public company, had 9 million ordinary shares of shillings 1 par value and 1 million 7% redeemable preference shares of shillings 10 par value on which date? 1st of October 2020. That is basically to the start of the year. The ordinary shares which have been issued as per paragraph 1 were 9 million. 9 million. These are the ordinary shares which have been issued by the company at the start of what? Of the year. Then from there we need to go down here, where we're given the transaction for the current year. We see which shares were then issued during the current year. Can we go to the information we are given in note number 1 up to note number 4? We are told the following transactions took place during the year which ended 30th September 2021. Number 1, we are told on 1st January 2021, the company issued 1.8 million ordinary shares in 145 right issue at a price of 2 when the market price per share was 5. So another transaction for the right issue. There was a right issue on 1st of January 2021. Actually, you can see all questions for this from this topic. They have that aspect of the right word, that aspect of the right issue. So I think because it's something you have come across in all questions, we need to do this a little bit fast, taking into account we know what is expected of us here. We need first of all to compute how many shares were issued by the company during the right issue. And then from there we compute the theoretical right price. So, yes. So we are told on 1st January 2021, the company, actually we're given the shares which were issued during the right issue here. We are told the shares which were issued during the right issue, they were 1.8. 1.8, which you are told is 145 right issue. 145. So the shares have already been computed, but assuming the shares have not been computed, remember you told the company was to make the right issue of 112 or 145. 145. It basically means that during the right issue, the company was to issue 1 share for 5 shares which were held. So in our case, we know the shares which were held before the right issue were 9 million. 9 million. So in this case, once you work out this, 1 times 9 million divided that with 5, that should give us 1.8. Whatever you have up there. Is that what you're getting? 1.8. 1.8. Is that what you're getting? Yes, yes. So having this, then what we need to do? We need to compute the theoretical right price. We need to determine how many shares had been issued before the right issue and how many shares were issued during the right issue. The shares issued during the right issue, we know they were 1.8 million shares. And then before the right issue, the shares which had been issued were 9 million. Were 9 million shares. 9 million shares. So what was the market price per share before the right issue? As per note number 1. Before the right issue, the market price per share was? The market price on the right basis was 5. Each share before the right issue had a market price of 5. And then these shares to be issued during the right issue, as per note number 1, we are told they were to be issued at a price of 2. They were to be issued at a price of 2. So we need to multiply this. This will give us 45. This will give us 3.6 million. So we add these 2, and also we add this. So this will give us 10.8. This will give us 48.6 million. 48.6 million. So we then compute the theoretical X-rate what? Price 48.6 million divided by 10.8 million. Yes, that will give us what? That will give us what? Yes, this will give us shillings 4.5 per what? Per share. And I think having that, we can come back here. We start by computing the shares issued at full market price, which will be equal to the amount received. The amount received here will be equal to the shares which were issued during the right issue 1.8 times the issue price, which was 2, divided that with the theoretical exercise price 4.5. And then these shares must be weighted on time basis. These shares will be held from January to September. These shares will be held for 9 months out of 12. We then compute the bonus element. The bonus element. These are shares issued free of charge, which is equal to the total shares issued during the right issue, 1.8 million, minus the shares issued at full market price, whatever you have here. 1.8 times 2 divided by 4.5. Then those shares should not be weighted on time what basis. Yes, what are you getting here? So here we have 1.8 times 2 divided by 4.5 times 9 divided by 12. So I'm getting 600,000 shares. What about here? Are you getting 1 million? Yes, 1 million, 1 million, 1 million. Okay. So having that, we need to move to the other transactions. The other transaction is on second. Second, that is note 2, not second. On 1st April 2021, 1st April 2021, we are told there was issue at full market price. Issue at full market price. This one is quite simple. We just take the shares which were issued, which were 1 million. 1 million. We just multiply them with the proportion of time they were held. These shares will be held for how many months? Are they 6? Are they 6? Yes, 6. From April to September. And basically that will give us 500,000. 500,000. Then note 3, we are told that on 1st July 2021, the company issued 5 million convertible bonds with an effective interest rate of 12%. The bond is convertible into ordinary shares at the holder's option on the basis of 60 shares for shillings 100 bond. None of the bond had was converted during the year. So meaning that those particular bonds were issued during the current year, but were they converted into ordinary shares? No, we don't consider them here because none of them were converted into ordinary shares. Note 4 is about the tax rate. So basically in our case, we are done. We are done because we don't have any other transaction for the issue of share. So this will give us what, 10 million plus 1.1. Are you getting 11.1 million? Yes, 11.1 million. So meaning that the basic earnings per share, BEPS will be equal to per post this one, 14,575,000 divided that with one off, 11.1 million. This will give us what? 1.313 shillings per what? Per share, shillings per share. That is what I'm getting from Benson. That is what I'm getting from Benson. Yes, are you getting the same? Yes. So that is it, that basically what is required. The 4 marks, basically that there was a mark for that, and also computation of theoretical accelerated price. Remember, there is always a tick for that. Sasa? Yes. So Roman 2, we are required to compute the restated EPS for the year which ended 30th of September 2020. So Roman 2. How do we compute this one? Quite simple. We have said we take the PATOS of this year, 2020. We divide that with WANOS for 2020 this year. And then to this WANOS, we add the bonus shares, which were issued during the current year. The current year is the year 2021. So the PATOS, basically remember, the profit after tax will be the same with PATOS. During this year, during the previous year. So do we have the profit after tax for the previous year, 2020? Yes. We have this in paragraph 3. In paragraph 3 of that question, which was 11.1. 11.1. Then we have the WANOS. The WANOS automatically will be equal to the shares which were issued and prepaid at the start of the current year, just like the other question. So will be equal to this, the WANOS, 9 million. And then out to this, we add the shares issued free of charge during the current year. The shares issued free of charge during the current year is this bonus element during the rights issue. And basically that will give us 10 million. The final answer here will be 1.51 shillings per word, shillings per share. Shillings per share. Is that what you're getting? Shillings per share? Yes. So, okay, so let's move to the last part. The diluted earnings per share for the year which ended 30th of September 2020. So what do we need to do? We follow our 3 basic steps. Identify the potential ordinary shares for each, compute the increase in earnings, increase the number of shares, finally compute what? Compute the basic, the diluted earnings per share. So the potential ordinary share, or basically shares which have been issued by the company in 2020. I think in this question we have two. So the first one is in paragraph 2. Paragraph 2 of this question, we are told this company had issued 2.5 million stock option. Stock option is a privilege given to the employees to buy the shares of the company in future at a price below the market price. So we have the stock option. Also, it is important to note that the preference shares which have been issued by this company as per paragraph 1, they are not convertible. So if you can remember the other question, they were redeemable and also convertible. In this question, they are redeemable, not convertible. So if they are not convertible, don't consider them here. We only consider them as potential if they are convertible. So the other potential ordinary share which we have here is what we have in note number 3. Note number 3. The convertible bonds which were issued by the company. Convertible bonds which were issued by who? By the company. So it means that here we have 2 potential ordinary share. Having identified this, we have said for each, we need to proceed and we compute 2 items: the increase in earnings, increase in number of shares. So we start with the stock option. For stock option here, the increase in earnings, and basically, this is something we discussed in our previous class. We say that this one is always equal to 0. I was able to explain in details why the increase in earnings is always equal to 0. And what about the increase in number of shares? The increase in number of shares, we see here we consider the bonus element. We consider the bonus element. So we ask ourselves, if the employees of the company exercise the stock option during the current year, they bought the shares during the current year, how many shares could have been issued to them free of charge? And actually, we say to compute this bonus element, we take the total shares which would have been issued to them, assuming they exercised the stock option during the current year, minus the issue at full market price. The shares which would have been issued to them at full market price, we say this one is computed by, first of all, determining how much amount would have been received from the employees if they bought the shares during the current year. Remember, they did it for, we said we compute this on an assumption. We compute the diluted earnings per share on the assumption that these potential ordinary shares were converted into ordinary shares. We divide this with what? With the average market price per share. Average market price per share. So let's compute that one. Because we have all the details in paragraph 2. We have all the details in paragraph 2. I will take the total shares. We are applying this formula here. So if the employees bought the shares during the current year, how many shares would have been issued to them? So remember, in paragraph 2, we are told as at that date, basically, which is the start, this company had also initiated 2.5 million stock options. The stock options are exercised at shillings with 1.5 per share. The average fair value, the fair value is the same with the market price per share during the year was 2 shillings. So in this case, how do we compute the bonus element? We take the total shares which would have been issued to the employees, which are 2.5. We minus the shares which could have been issued to them at full market price, which is equal to the amount which the employees would have paid for these shares, which is equal to the shares which would have been issued to them times the exercise price. So if the employees bought the shares during the current year, they were to pay 1.5 shillings per share. That is the amount which would have been paid per share. And then divide that with the average market price per share. The average market price per share, we are told is what? Is 2 bob. Is 2 bob. So whatever you compute here is the bonus element. These are the shares which are considered to be dilutive. These are the shares which are considered to be dilutive. And in this case, I'm given a figure of 625,000. So we are done with that one, with this one. So then we come to these convertible bonds. Now for the convertible bonds, we start by computing the increase in earnings. And basically this one we know is equal to the interest paid multiplied this with 1 minus the tax rate. We multiply that with the 1 minus tax rate. So we are given information about this in note number 3. So on 1st July 2021, the company issued shillings 5 million convertible bonds with effective interest rate of 12%. So the interest which was paid during this year was 12% times 5 million. But remember, this is the interest per annum. So if the debentures are not debentures, but bonds were issued in course of the current year, the company should not pay the interest for the whole year. The interest which was paid was from July, from the date they were issued, that is 1st July, as per note number 3, 1st July 2021, to the end of the current year. The current year ended 30th of September 2021. So the company paid interest only for this period. How many months do we have here? How many months do we have? We have July, August, September. So, yes, so our company paid interest for just 3 months. So this is the interest which was paid. We multiply that with 1 minus tax rate. The tax rate in note number 4 is 30. So 1 minus 0.3, which will be 0.7. That will give us the increase in earnings of how much? Yes, the increase in earnings here I'm told is 105,000. 105,000. Finally, we compute the increase in number of shares. For us to compute the increase in number of shares, we must have the conversion rate. The conversion rate is still given in note number 3, sentence 2. We are told the board is convertible into ordinary shares at the holder's option into 60 shares for or per shillings 100 board. Shillings 100 board. And take into account there are no boards which were converted into ordinary shares, then we will use the boards of 5 million. So we know the boards which had been issued by the company, they had a value of 5 million. So we cross multiply, then we divide. 60 times 5 million divided that with 100. So this will give us the number of ordinary shares which would have been issued, assuming the conversion took place during the current year. It is also important for you to note that if these particular boards were converted into ordinary shares, these ordinary shares would have been held for how many months during the current year? If these boards, which had a value of 5 million, were converted into ordinary shares, these ordinary shares during the current year would have been held for how many months? That is something which is also important for you to determine. If the holders of these boards, they converted them into ordinary shares, the ordinary shares which were issued on conversion would have been held from which date? Automatically, those ordinary shares would have been held from the date the convertible boards were issued. Those shares would have been held for 3 months. So therefore, the shares which you get here, the shares which would have been issued on conversion, equally, you have to weigh them on time basis, because those shares would have been held for 3 months. But if these boards, the boards which had a value of 5 million, had been issued at the start of the year, they were starting from the start, then in this case, we assume if they were converted into ordinary shares, then the conversion would have taken place from the start of the year. And those ordinary shares would have been held for the whole year. Sasa? Yes, yes. This therefore will give us what? Will give us 750,000 shares. And I think having this, we proceed and compute the diluted earnings per share. So the diluted earnings per share, we will take the PATOS and WANOS, and I think is what we have here, 14,575,000, that is the PATOS. WANOS is 11.1 million. And then in this case, taking into account we have 2 potential ordinary shares, we will add the increase in earnings for both. The increase in earnings for stock option is 0. So even if that is 0, make sure you write it there, it has a mark. Then the increase in earnings for this, which is 105. To this WANOS, we add increase in number of shares for both. The increase in number of shares for this one, for stock option, is this one, 625,000. And the increase in number of shares for this is what? 750,000. 750,000. So these are the items which are basically marked. Those are the items which will give you the marks here. So, and basically compute that. You give me the answer, which should be shillings per share. Shillings per share. Shillings per share. I'm given by Gilbert 1.1 1.177 shillings per share. Is that what you're getting? Yes. So that is also confirmed by Medium. Is also confirmed by Medium. So that is it. That what was, or basically that's what you need to know as far as that topic is concerned. That brings us to the end of that topic of earnings per share. And basically say that these are topics you should expect in this teaching. In the teaching for August, there will be a question from this. Because if you check on the pattern of this topic, if it is not examined in this topic, in this teaching, it will automatically be tested in the coming teaching. So there is a question here for August of 2024. I can't remember the specific question, but that question I want to give it as an assignment. You go to that paper for August 2022. You check there is a question on what? There is a question on this earnings per share. You attempt it. In case there is any problem, you will let me know. Sasa, yes, we stop at that point. Have a nice evening and also a nice weekend. We continue from here in our next class on Tuesday. So have a good night. Number one, ratio analysis. Number two, trend analysis. And number above, describe how each of the above tools is utilized in practice. So basically, we are told that in analyzing the financial statement today, there are various tools which can be used by the financial analyst. We have the ratio analysis, trend analysis, the common size financial statement. And basically what we are required to do here is we describe, or in other terms, we explain how those particular tools are used in practice. How those particular tools are used in practice. And the first tool we are required to explain is the ratio analysis. Ratio analysis. So how is this particular analytical tool used in practice? So if you can be able to recall, in our first session, we said that ratio analysis, this is one of the tool, or basically one of the technique used in analyzing financial statement, and this tool entails computing financial ratios. So that basically what we are required to explain, that this tool entails computing financial ratios, various financial ratios, and maybe you can go ahead and you explain what is a financial ratio. So we can say that this tool entails computing various financial ratios from the financial statements. So you compute various ratios from the information which is contained in the financial statement. Now, what are financial ratios? We can proceed and we define what are financial ratios. We say financial, or a financial ratio is a relationship between two or more financial variables, between two or more financial variables. That is the definition of a financial ratio, basically by explaining what ratio analysis entails, and maybe explaining what is a ratio. So basically, in that case, you get 2 marks. You get 2 marks because you can see the marks allocated. There were 6 for explaining those 3 tools. Let's move to the other tool, which is the trend analysis. The trend analysis. So who can remind us here? The other name for this is what? The trend analysis is also known as what? Trend analysis. The other name for this, who can be able to recall? We had another name. We talked about another name for this. Nul, can you be able to remember? Juliet, Zipporah, can you be able to remember? Helen, can you be able to remember the other name for this? The other name for the trend analysis. Yes, trend analysis in this case we said is also known as the horizontal analysis. The horizontal analysis is also known as what? The horizontal analysis. And actually, if you can be able to recall, we said that this is a type of analysis which is done in order to establish the change, or basically the increase or decrease of the figures in the financial statement of a certain financial year as compared to a certain base period. So we can say that this is an analysis done to do what? To establish change, which is basically the increase or decrease, to establish the change, which is the increase or what? Or decrease of financial statement items, of a certain financial year, of a certain financial year, compared, or basically as compared to a base period, So this is a type of analysis which we do to establish whether the figures, in the financial statement of a certain financial year increased or reduced as compared to a certain base period. For example, in this case, we said you can be given financial statement for 2 years, 2024 and 2023, and you are required to do something called the horizontal or the trend analysis. So what you are required to do in such a case is to determine whether the figures in the financial statement for 2024 increased or basically reduced as compared to the figures which are included in the financial statement for the year 2023. So that one is called a horizontal or the trend analysis. So number 3, we're required to explain what is or how the common size financial statements are basically prepared. The common size financial statements. So common size financial statements, we said, are financial statements which are prepared by basically expressing items within the financial statement as a percentage of a certain base item. For example, in this case, we say we can prepare the common size income statement by expressing all items in the income statement as a percentage of revenue or as a percentage of sales. Equally, we can prepare a common size statement of financial position where we express all items as a percentage of total assets. So therefore, we can say that these are financial statements. These are financial statements prepared by expressing the items, the items which are within the financial statement, items therein as a percentage of a certain base item, as a percentage of a certain base item, e.g. the revenue, or total assets, We prepare this particular financial statement by expressing, for example, the items within the income statement as a percentage of revenue, expressing items within the statement of financial position as a percentage of the total asset, So this is the explanation which was required, and I hope you can see the marks allocated. There were 6. Automatically explaining these 2 marks, explaining these 2 marks, and also explaining these, how many marks? 2 marks were allocated there. 2 marks were allocated there. So I want us to move to the other part of that question, because that is what was required in part A. So let's move to part B of that particular question there. We move to part B. Let's move to part B. So in part B of that question, this was requiring computation of various ratios. So what are we required to do? Okay, before we go to part C, so there is also part B there. And part B reads, summarize 4 attributes of a good financial statement analysis. 4 qualities of a good financial statement analysis. 4 attributes. So part B, attributes. So basically attribute in this case, I'm saying are the same with qualities. Qualities of a good financial statement analysis. Qualities of a good financial statement analysis. Now, these particular qualities or these particular attributes of a good financial statement analysis, they are the same with the qualities of a good financial information, because once the company has prepared the financial statement contains certain information which is supposed to be relied upon by the various users, including shareholders, including potential investors, including management, in terms of making certain decisions. The same case, once the person who is called the financial analyst is analyzing the financial statement, he is supposed to analyze those financial statements and then provide more information to the users, like the shareholders, like the potential investors, use that information to make certain decisions. So what are the qualities? What are the features? What are the attributes of a good financial statement analysis? And basically, I've said that these are the same with the qualities of a good financial information. So therefore, those particular attributes, number 1, we can talk of maybe what? Timeliness. Timeliness. And basically, this means that a good financial statement analysis must basically provide the required information on time. Must provide the required information on what? On time. So we can say a good financial statement analysis, FSA, good financial statement analysis must provide the required information on time. The required information on time. So mean that if, for example, you are the person who is required to analyze the financial statement of the company, maybe provide certain information to certain users so that if they can use that information to make certain decisions, then you must provide that information on time. Otherwise, if you provide the information when it is too late, then that information cannot be used by those users in terms of making what? In terms of making their intended decision. Number 2, or the other attribute is basically what? Number 2, we can also talk of maybe relevance. We can talk of relevance. Relevance means what? Relevance means that the information which is provided by the financial statement analyst, that information must be relevant. That information must help the users to make the intended decision. In other terms, that information must influence the decisions which will be made by the user. So therefore, you can say the information provided by the financial analyst must influence the user's decision. But if, for example, a financial analyst has analyzed the financial statement of the company, you have been given information, but you cannot be able to use that information to make your intended decision, then we say that information is totally irrelevant. It's totally irrelevant. So mean that is not a good financial, or a good financial statement analysis has not been done, because you have been given information which cannot influence your decision, which cannot influence your decision. Then number 3, we can also talk of reliability. We can also talk of what? Reliability. Reliability basically means what? Reliability means that the information which is provided by the financial analyst, number one, that information must be complete. Number two, that information should also be free from any errors. Otherwise, if you're given information by a financial analyst which is not complete, information which is full of errors, can you be able to rely on that information in terms of making the intended decision? Automatically no. So therefore, that information has to be complete. That information has to be what? And to be free from any error. So we say the information provided by financial analysts must be complete, and free from any errors. Free from any errors. Must be complete and free from any errors. Free from any word errors. So if that is the case, you're given information, or the information which is provided by the financial analyst is basically complete, it is free from any errors, it automatically means that you can be able to rely heavily on this information in terms of making your intended decision, decision. So also here we can talk of maybe the comparability. We can also talk of comparability. Comparability basically means what? Comparability means that the information which is provided by the financial analyst, number one, should help you as the user in terms of comparing the performance of the company for in a number of years. You can use that information to compare the performance of the company in a number of years, or even to compare the financial position of the company in a number of years. And number two, that information, you can also use it in terms of comparing maybe performance of different companies within the same industry. So we say the information provided should enable the users to compare performance of a company with other companies within the same industry. And also in this case, we have said it should also help you in terms of comparing the performance of company in different years. So these among others are basically some of the attributes of a good financial statement analysis. So the marks which were located there basically were for each of the attributes, for each of the quality, the marks are located there were 1. Yes. I hope you're together up to that point. Are we together up to that point? Rachel, tuko pamoja, Lucia. Are we together up to that point? Helen is confirming you're together up to that point. Francis, I hope you're together. Okay. So if you're together, then I want us to do the last part of that question. The last part. And the last part was requiring the computation of various ratios. So let's go through the other part of that question. We see what we are told. And the question is, the following are extracts from financial statements. The following are the extracts from the financial statements of the 𝐷 Limited. So extract is part of. So those particular financial statements which are given here, they are not complete. They are part of. Extract is part of something. Is not the complete. For example, these are not complete financial statements. So we are given extract of the income statement for the year which ended 30th of April 2020 and 2021. So what do we have? We have the sales revenue, we have the cost of sales, which approximate purchases. We have the gross profit, administrative expenses, distribution cost, finance cost, and then the profit before tax. We have the extract of the statement of financial position, where we have the non-current assets, which comprises of PP, intangible assets. We have the current assets, which include inventories, trade receivables, cash, and cash equivalent. We have the current liabilities, which comprises of trade payables and current tax payable. So then we are told to assume a 365 days financial year. What are we required to do? We are required to analyze and interpret the performance and efficiency of the company for the 2 years, ended 30th of April 2020 and 2021, using the following ratios. So number one, we are required to compute the gross profit margin. Number two, the return on capital employed, inventory turnover period, trade receivables correction period, and trade payables payment period. So let's start with the Roman 1 of that particular question. Roman 1. And basically, which ratio are we required to compute there? The gross profit margin. And actually, we are required to compute these ratios for 2 years, 2020, 2021. Recall what we said in our previous session. If we are required to compute ratios for 2 years, it is always advisable to start with the year which comes first, so that you can be able to see the movement, the change, or actually the change, or actually the trend. So we start by computing the ratios for 2020 and then 2021. So how do we compute this ratio here? Remember, we say that some of these particular profitability ratios, you don't even have to cram the formula. Like this one, anytime you see the word margin, margin, so when computing this ratio, the formula for this ratio is that the denominator has to be revenue. Anytime you see the word margin, the denominator has to be what? Revenue. What about the numerator? The numerator is the one which comes first there, which is the gross profit. So therefore, this one is computed by taking the gross profit all over revenue. And actually, revenue in this case, we said, is another name for sales. Is another name for sales. Yes, so we need to go back to our income statement, both the gross profit and the revenue or the sales. Where do we get them? We get them from the income statement. So, and actually, the income statement is given at the paragraph 1. So, can we go back to paragraph 1? So below paragraph 1, where we're given the extract of the income statement, So we can start by taking the gross profit. The gross profit is basically, we have that in the extract of the income statement. We have the sales revenue, cost of sales, and then below that we have the gross profit. The gross profit for 2020, I hope you can see that, is an amount of 103,812. So basically, you're going to multiply that with 100. What about now the year 2021, before we record the revenue? The gross profit for 2021 is 117,902. We multiply that with 100, and then we divide this with the revenue. So revenue, which is also known as the sales, this is the first item within the within our income statement. I hope you can see the revenue, or which is known as the sales revenue. For 2020, this one is 476,200, and this one is what? Is 701,800. So that is how we compute the gross profit, and take into account this a profitability ratio. We always express this as a percentage. As a percentage. So give me the final answers here. We starting with 2020. 2020, once you get the answer, type it in the chat box. I'll be able to see it. You type it in the chat box, I'll be in a position to see it there. Yes, I'm given a figure here by Helen, which is 21.8. 21.8, is that what you're getting? 21.8, is that what you're getting? Yes. So that has been confirmed by Juliet. Yes. So we do the same for 2021. Give me the final answer there. Give me the final answer. 16.8. 16.8. 16.8%. Yes. So that's how we compute the gross profit margin. So let's move to the other ratio number 2, and that is the return on capital employed. The return on capital employed is abbreviated as ROCE. So how do we compute this one? And this basically ratio, which is very, very common, is a very, very common ratio, simply because the two items which are used in computation of this ratio, none of them, in most of the cases, will be given by the examiner. You have to compute the two parameters, the two variables, which are used in computing this. So how do we compute ROCE, the return on capital employed? In this case, we take the profit before interest and tax, abbreviated as PBIT. This one is also known as the operating profit. Operating profit. We divide this with something called the capital employed. Capital employed. We divide this with the capital employed. Capital employed. So make sure you write that in full. And then, because it's still a profitability ratio, we multiply this with 100. We multiply that with 100. Now, I'm saying in most of the cases, these two items, profit before interest and tax, capital employed, these are two items which the examiner will not have given you. Automatically, this one, we get it from the income statement, the profit. What about the capital employed? Capital employed, there are two formulas for computing the capital employed. Capital employed can be computed by taking the non-current assets plus current assets minus current liabilities. That is the first formula we can use to compute the capital employed. Non-current asset plus current asset minus current liabilities. Alternatively, we can compute the capital employed by taking equity plus non-current liabilities. And you have to remember these two formulas, because the formula which you use, it always depends with the information which is given. For example, if you check on this particular question here, specifically in the extract of the statement of financial position, we don't have equity, we don't have non-current liabilities. It automatically means that we can't use the second formula. We can't use the second formula. We can only use the first formula. Non-current assets plus current assets minus current liabilities. That's why I'm saying you have to remember those two formulas of computing the capital employed. But even before you compute the capital employed, I want us to check whether we have this one. Do we have the profit before interest and tax, or do we have the operating profit from the income statement? Can we go back to the income statement, which we have below paragraph 1? So we are given the sales, we are given the cost of sales, we have the gross profit, we have administrative expenses, distribution cost, finance cost, and then we have the profit before tax. Now, in our case, do we have this profit before interest and tax? No, we don't have this profit before interest and tax. Now, how do we compute the profit before interest and tax, which is not given? So this one is computed by taking the profit before tax, because this one we have it. This is the last item within the income statement, profit before tax. And then now to this, we add interest. And this interest, in other terms, we also refer to it as the finance cost. And actually, this finance cost is just above the profit before tax. So when we are given the profit before tax in the income statement, this one, so below that, I hope you can see something called the finance cost. So what we do to compute the operating profit, compute profit before interest and tax, take the profit before tax, you add backward the interest. So that's what we need to do here. So we take the profit before tax, this one, which is given as the last item within the income statement. For 2020 is given as 50,850. And then to this, we have said we add finance cost, which is also known as interest. And the interest in that case is 72. So that will give us the profit before interest and tax. The profit before interest and tax. We do the same for 2021. For 2021. So the profit before interest and in tax will be equal to profit before tax 42,960 plus interest, which is 10,800. 10,800. We multiply that with 100. We multiply that with 100. So that is how we compute the capital employed. Sorry, not the capital employed, the operating profit or the profit before interest and tax. Next, I want us to determine the denominator, capital employed, and this time I've said we are going to use this formula here. I've said you can use this, but based on the information which you are given, automatically we can't use the second formula. We can only work with the first one. We can only work with the first one. So how do we compute this? We take the non-current assets, and the non-current assets are given in our statement of financial position. Non-current assets for 2020, which comprises of property, plant and equipment, and intangible assets, they have a value of what? They have a value of 18,140. So that is the non-current assets. Non-current asset. To this we add the current assets. The current assets, I hope you can see that still in our statement of financial position. The current asset comprises of inventory, trade receivables, and cash equivalent. So if you add those three figures, we are given their total downstairs, which is 236, 236, 695, 695. That is the total current asset. And then we less the current liabilities. Current liabilities is below where we have the current asset. Current liabilities comprises of trade payables, current tax payable. The total figure for current liabilities is 179,835. And that is how we compute the capital employed. So we do the same for 2021. So the capital employed here will be equal to non-current assets, 18,81,500 plus current assets, which is 35,500 minus current liabilities, 297,000. 297,000. Yes, so we work out now. We compute the final figure. These are a profitability ratio. We express it still as a percentage. So give me the final answers here, starting with 2020 here. Starting with 2020, you give me the final answers here. You give me the final answers. Give me the final answer. What are you getting is the final answer? The final answer here. The final answer. Yes, what are you getting? $2020, I'm given 5.4. 5.4, that is the figure I'm given here. Yes, what about 2021? What are you getting for 2021? What are you getting? Yes, so here I'm given a figure of 2.8. So this, remember, is a profitability ratio, So let's move to the other ratio, which is ratio number 3. In ratio number 3, what are we required to compute here? What are we required to compute in ratio number 3? We are required to compute the inventory turnover period. Number 3, inventory turnover period. Now, the inventory turnover period, this is one of the efficiency, or basically one of the activity ratio, which is basically a ratio which is computed to determine how efficient the company was. How do we compute this ratio here? To compute this one, we take the what? We take the average inventory. We divide this with something called the cost of sales. And basically we multiply this with the number of days in a year. And if you can be able to recall, we are told to assume a 365 days year. 365 days here. So why do we compute this efficiency or activity ratio? This ratio is basically computed to determine how long the company was taking to sell inventory. So on average, this company was taking how many days to sell inventory? So basically what you mean by that, if, for example, you have a business and maybe you have bought some stock, it takes you how many days to sell that inventory. So if you're taking too long, then we say that your business is not efficient, because once you have stocked some goods in your business, you should be able to sell them within a short period of time. You get some profit, you go back to the supplier, you buy other goods, you stock them, and then you sell them. But if you're taking too long to sell goods, then we say your business is not what? Efficient. So this is basically how we compute that ratio. Average inventory divided that with the cost of sales times what? 365 days. So how do we compute this average inventory? Average inventory is computed by taking opening inventory plus closing inventory divide that with 2. That is how we compute the average. But now in this case, we only compute average. We only compute the average in case the examiner has given you the opening inventory, because where do we get inventory? The inventory we know is part of the current asset. Can we go back to the statement of financial position which are given in our statement of financial position, specifically where we have the current assets? So if you go to where we have the current assets, I hope you can see we are given inventories there. And we are saying here to compute the average inventory, we take the opening inventory plus closing inventory divided that with 2. Now that inventory, which is in the statement of financial position, is it the opening? Is it the closing? Which inventory do we record in the statement of financial position? The opening or closing? This is something you know basically from financial accounting. Which inventory do we record in the statement of financial position? Is it the opening? Is it the closing? That inventory which we recognize as an asset in the statement of financial position, I'm told by Helen, is opening, closing. Yes, automatically. Remember, whenever you're preparing a statement of financial position, you prepare it as at the end of the year. So the inventory which you show there is the inventory which was there at the end of the year. And that inventory to the business is an asset. So therefore, the inventory which are given at the current asset is the closing. But we are saying, for us to be able to compute this average, for example, for the first year, we must be having the opening, inventory, and the closing. So for the first year, we only have the opening. Sorry, we only have the closing, not opening. We only have the closing. And actually, the closing inventory for this year, that is the year 2020, the closing inventory is 81,000. Are we given the opening inventory? No. And therefore, it is important for you to note that anytime you come across a question and the examiner has not given you the opening inventory, it basically means that you can't be able to compute the average. And therefore, instead of working now with the average inventory, we replace this average inventory with the closing inventory. With the closing what? inventory. So therefore, we only use the average inventory in case the examiner has given us the opening inventory. That is the only time you can be able to compute the average. But if you are not given the opening inventory, then what you do, you replace this with the closing. And actually that will apply to year 1, year 2. Will apply in year 1 and year 2, because in year 2, we can be able to compute the average. Because the closing inventory for year 1 will be the opening for year 2. But in this case, I'm saying we only compute the average in year 1 and year 2, whereby we are given the opening inventory for year 1. For year what? For year 1. If you're given the opening inventory for year 1, you can be able to compute average inventory for year 1 and for year 2. But if you're not given the opening for year 1, in both years, year 1 and year 2, don't compute the average. Even if year 2, we can be able to compute. Just use what? The closing. I hope that is clear. Because these are questions as most of the students keep on asking, why are we not computing the average in year 2, yet we have the opening and closing? I've said because in year 1, you can't be able to compute the average, even in year 2, don't compute. But if you can be able to compute the average for year 1, also in year 2, do what? Do compute. So you can only be able to compute the average for year 1, whereby the examiner has given you, maybe as part of the additional information, the opening inventory for the first what? Year. Yes. So instead of working with the average, we will work with the closing inventory. The closing inventory is what we have under the current assets. So for this year is 81,000. For this year is what? Is 81,400. Basically, we have to multiply that with the number of days in a year, 365, and then we divide that with the cost of sales. Cost of sales, where do we get this? We get this from the income statement below revenue. So this one is given for the first year, 372, 388, and this one is given as what? Is given as 583, 898, 898. So this, okay, sorry. So the answer which we get here is always given in days, and because these are days, give me the answer to the nearest whole number, because these are days. Give me the answers to the nearest whole number. Because they are days. We can't have a point of a day. So give me the answer to the nearest whole number. 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 The first year here, I'm given 79. That is the answer I'm getting from Rachel. That is what I'm getting. What about 2021? What about 2021? 2021, what are you getting there? 2021. What are you getting? Yes, I'm given a figure for 51 days. 51 days. So in this case, we have said the shorter the number of days, the better. During this year, the company was taking 79 days to convert inventory into sales, or to sell inventory, but during this year, the company was taking 51 days. So we have seen the shorter the number of days, the better. It basically means that if the company is taking a short period of time to convert inventory into sales, then the company is more efficient. So let's move to the other ratio, which should be our ratio number 4, and that is the trade receivables. The trade receivables correction period. correction period. So still this is an efficiency ratio, is a ratio which is computed basically to determine the number of days on average this company was, or to determine on average the number of days the customers or the debtors of this company were taking to clear their debt. Equally, in this case, we say your customers should not take a very long period of time for them to clear their debt. Otherwise, if they do that, your business may start experiencing liquidity problem. You are selling goods on credit to your customers, you're providing services to your customers on credit, but they are taking too long to pay their debt. So your business may start having cash flow problems. So you must ensure that your customers are paying within a short period of time for you to be able to clear maybe or to meet your financial obligations. So therefore, how do we compute this one? We compute this by taking the average trade receivables, the average trade receivables. We divide this with the credit sales times 365 days. 365 days. So remember, you said that all these particular formulas, you must be able to remember them. In the notes I shared with you, all these particular formulas are there. Yes. So how equally do we compute this one? Average receivables, average trade receivables. The same concept here. We take the opening trade receivables plus the closing trade receivables, divided that with the 2. But equally, the concept I've explained here for the inventory also applies here. We only compute the average trade receivables, whereby the examiner has given us the receivables at the start of the first year. The receivables at the start of the first year. But if you check on this question, we only given the receivables in the statement, or the only receivables which we have are the receivables in the statement of financial position at the current assets. And remember what you have said is that a statement of financial position is prepared at the end of the year. So the receivables which we have there are the closing. So do we have the receivables at the start of the year? For example, in year 1, we don't have them. So the same concept I've explained here for inventory will also apply here. So we only compute this average receivables, whereby the examiner has given us the opening receivables for the first year. But if you're not given that, then instead of using the average, what do we use here? We use the closing. We use what? The closing. Sasa? Yes. So let's do that. We will not compute the average because you're not given the opening for the first year. We are going to work with the closing receivables. The closing receivables have said these are the receivables in our statement of financial position at the current assets. So for the first year, 95 to 40 times 365. Then here we have the receivables 175 for 50 times 365, and then we divide that with the credit sales. Now the credit sales, I think in our question which we're given the sales in the income statement. The examiner is not specific on whether those sales were on cash or basically were on credit. What we are interested with here are the sales made on credit. Sasa? Yes, equally, in this case, if the question is silent, if there is no information which the examiner has given you regarding how much were the credit sales, regarding how much were cash sales, then in this case, we assume. If the question is silent, we assume all sales were on what? On credit. All sales were on credit. But I think you'll be able to see there was a question, I think, for 2024. The examiner was very much specific that the credit sales were 75%. 75% of what? 75% of the sales. But if we are saying if the question is silent, you're just given sales, there is no any information you're given about how much were credit sales, you assume all sales were on credit. Sasa? Yes. So therefore, the sales we are given for 2020, and I hope you can see where we are getting this one. We are getting this from the income statement. So 476,200, and here we have 701,800. 800. And then what we need to do is basically we get the final figure, and the answer will be in days. The answer will be in days. The answer will be in days. The number of days the customers were taking to clear their debts. Were taking to clear their debts. The shorter the number of days, the better. The shorter the number of days, the better. So give me for, we start with that of 2020. Is what I'm getting. I'm given 73 days by Helen. 73 days. What about, yes, and I hope the rest are getting the same. Angela, are you getting the same? Have I seen any answer from Francis? I've not seen any answer from Francis here. Francis, I've not, I think, seen an answer from you. So once you get the answer, type it in the chat box. The poll is confirming it. So to the nearest whole number, should this be 73 or 74? 73 or 74 to the nearest whole number? Okay, to the nearest whole number should be 73 and 91, 73 and 91, 73 and 90, 91 days, 73 and 91 and 91. The shorter the number of days, the better. The shorter the number of days, the better. So we have the final ratio which we are required to compute, the trade payables payment period. So let's compute that one. Trade payables, number 5. Trade payables payment period. Payment period. So the trade payables payment period, this is basically a ratio, on the other hand, which is computed to do what? To determine on average the number of days this company was taking to pay the suppliers, to pay the creditors. How do we compute this ratio? This one is computed by taking the average trade payables. The average trade payables. We divide this with the credit purchases. Credit purchases. In case the examiner has not given you the credit purchases, what do you use? You use the cost of sales instead. But if you check on this particular question here, specifically the income statement and below the sales revenue, we are given the cost of sales, but equally we are told that the cost of sales approximate or are the same with the purchases. That's why we are saying, if the examiner has not given you the credit purchases, instead use the cost of sales. Then automatically we multiply that with 365 days. 365 days. Now the concept which I've explained for inventory, for average inventory, for average trade receivables, also applies here. How do we compute the average trade payables? We compute this by taking the opening trade payables plus the closing trade payables divided that with 2. Equally, we only compute the average, we only work with the average, whereby the examiner has given us the opening payables for the first year. If you check on this question, we don't have the opening because the trade payables which we have in our statement of financial position and the current liabilities, those are closing. Those are closing trade payables. So in our case, we don't have the opening. So instead, we will not work with the average, but in this case, we are going to work with our closing, So therefore, let's take the closing trade payables, which is part of the current liabilities, within our statement of financial position, and that is 111,715. So automatically we multiply that with 365 days here, and then for the other year, we do the same. We take the payables 204, 365 times 365, and then we divide that with the credit purchases. So in our case, we are told the cost of sales is the same or approximate the purchases. But are we with all purchases? No, we are interested with the credit purchases. And the concept equally I've explained down here about the credit sales will also apply here. If you're given a question and the examiner has not specified how much were the credit purchases, you also assume all the purchases were on credit. We assume all the purchases were on credit. But in this case, remember we have said there are some instances whereby you can be told maybe the credit purchases, for example, are 75% or 80% of the purchases, in which case you can be able to determine how much were the credit purchases. But because the question is silent, we equally assume. We assume all purchases were on credit. We assume all purchases were on credit. So our purchases for the first year, which approximates cost of sales is 372,388, and here we have 583,898. So then we get the final answer, which will be in days, here, in days. So give me the final answer here. Okay, so I'm given 109, 109, and basically 128. 109 and 128. Yes, so that is it. That basically what was required is such a question. So in such a question, what does the examiner mark? The person who is marking your paper, that is not the examiner, the marker. What does he mark? So what is marked in such a question is always the final figure. This one, this. So usually in financial reporting, unlike in financial management, here the formulas are not marked. In financial reporting, formulas are not marked. But if you go to a paper like FM, because of the numerous formulas, formulas are usually marked. But in FR, no. So what, for example, will be marked here, and take into account the question had 10 marks. So it's based, and 10 marks, 5 ratios. So it basically means that for each ratio, the marks allocated were 2. So like here, the final answer was marked. The final answer, you get 2 marks there, 2 marks for getting that and that, and here 2 marks. So by the end of the day, you get what? You get a total of 10. You get a total of 10. But what is important as far as the computation of ratios is concerned, is all about the formula. If you can't be able to recall the formula for the ratio, then it is not possible for you to be able to compute the required ratios. So that is it. That basically what is required as far as that question is concerned. So the very good question from this topic of analyzing the financial statements. There was, I think, still another question on ratios, which I want you to check, and then maybe we can come back and guide you, I guide you on that question. It is from the sitting of April. Someone is asking about the interpretation part. Okay, so in this case, here, you may decide not to proceed to interpretation because I've said the marks would be allocated like that. But if you decide now to proceed to the interpretation part, there is something I mentioned in our previous session, that you must be able to classify these particular ratios. These 5 ratios which you have computed, they fall under which category? If you check on the first 2 ratios which you have computed, I hope you can see the first 2 ratios, the gross profit margin and the return on capital employed. So those 2 ratios which fall under which category? Who can tell us? The gross profit, the return on capital employed. These fall under which category? Out of the 5 categories of ratios, they fall under which category? Who can tell us here? Not performance. We don't have performance, but they fall under profitability. So therefore, if you decide to make now a comment, one, you can give a comment. You can make a comment on company's performance, on company's financial performance, or basically you can make a comment on company's profitability. And in this case, when making this comment, we say this has to be supported. You have to make this particular comment, or your comment must be supported by the two profitability ratios. Now, checking on those two profitability ratios, the return on capital employed and the gross profit margin, which year can we say the company was performing better? Is it 2020 or 2021? Or which year was the company more profitable? Is it 2020, 2021 based on those ratios? Remember, for profitability ratios, we go for the higher ratios. We go for the higher ratios. From our ratios, which year was the company more profitable? Yes, it is 2020. So therefore, in that case, you can say the company was more profitable, in the year 2020 than the year 2021. And then in this case, we said, other than making that comment, you must be able to substantiate this. You are making this comment based on what? Based on what? So we said you must support this, and you say the company was more profitable in the year 2020 than the year 2021, as evidenced or maybe shown by the return on capital employed and the gross profit margin. And the gross profit margin. So in that case, you can see, for you to be able to make this particular comment, one, you must be able to check on the ratios you have computed, and you check those ratios, or you basically identify the category under which each of those particular ratios, or basically the category which each of the ratio relates. So this relates to the profitability ratio. So then from there, we have also computed the inventory turnover, the trade receivables correction period, and also this one, the trade payables payment period. All these are basically efficiency ratios. All these are efficiency ratios. So if you decide now to make a comment, you come here and you make a comment on company's efficiency. A comment on company's what? On company's efficiency. And basically you check on these particular ratios, you make a comment, a general comment, relating to the year in which the company was more efficient. Was more what? Efficient. For example, in this case, we have seen inventory turnover, the company would be regarded to be more efficient if the company is taking less days to convert inventory into sales. So here we can say this year the company was more efficient because this at 51, this 79. So this is the year the company was more efficient, maybe as indicated by this. This one, trade receivables correction period, the number of days the customers were taking to pay their debt. The shorter the number of days, the better. The shorter the number of days, the better. So it means that here the company was more efficient. And then this one, the number of days the company was taking to pay the suppliers or the creditor, still the shorter the number of days, the better. The shorter the number of days, the better. So 2020 was the year the company was more efficient. Though this one is contradicting with the others, maybe we can just pick the majority. So out of the three efficiency ratios, two of them, this one and this one, shows that the year the company was more efficient, it was what? Was the 2020. So based on the majority of the efficiency ratios. Yes, so you can still make that a comment that the company was more efficient in the year 2020 2020, then year 2021, then year 2021, as shown. You must also add that as shown or evidence, as shown or evidenced by what? By this one, by the trade receivables, because I've said we are going to make a comment on the majority of the efficiency ratios as shown by the trade receivables correction period and the trade payables payment period. And the trade payables payment period. Trade payables payment period. Sasa? Yes. So that's basically what we say. If you are required to make a comment, you must first of all go back to the ratios which you have computed, and you see those particular ratios fall under which category. So there is this other question which was tested in the sitting of April 2022, and that is specifically question number 2. Question number 2. I want you to check on that particular question as we take a short break of 10 minutes. And then once we come back, I want you to tell me whether you can be able to do that question. Is the question doable or not? And then I'll be able to guide you. Sasa? Yes. So we take that short break of 10 minutes. We come back at 3:35 so that we can look on that question. We will not do it. I'll just guide you, and then I'll give that question as an assignment. Sasa? Yes. So see you after that short break of 10 minutes. Is the question doable? This question for April of 2022. Majority of the students who did that paper, they encountered a lot of problem because they said that there are no ratios which are known as equivalent ratios. Helen, is this question doable? Juliet, is the question doable? Is the question doable? Is the question doable? Yes or no? Francis, Juliet, can you be able to do this question? Can you be able to do that question here and you get those 20 marks? Zipora, is the question doable? Ajra, hii swali inafanyika ama ni ngumu sana? Yes or no? Let me get your feedback. Let me get your feedback in the chat box. Is the question doable? Yes or no? Yes or no? Is the question doable? Is the question doable? Is the question doable? I'm not getting any feedback. I can't see any feedback here. Beto, is this question doable? Francis, Juliet, is the question doable? Is the question doable? The question for April 2022. This question. We told here. So we are told the foreign trial balance was extracted from the books of 𝐵𝐸𝑚𝑝𝑜𝑤𝑒𝑟𝑒 at the end of the year. How do we prepare this one? We prepare this based on the accounting equation. The accounting equation we states that if you take assets are equal to capital plus what? Liability. So therefore, in preparing this, we start by recording assets, and then you also have to record that assets are classified into two: the non-current asset and the current asset. I was able to explain what you mean by the non-current asset. We say that these are the assets which are acquired by the business to help the business in terms of generating revenue or in terms of generating what? Income. If, for example, you have a business, you may decide to buy a motor vehicle. That motor vehicle is to help you in your business to make revenue. So these are the assets acquired to help a business to generate revenue. And number two, we said these assets are expected to be used in a business for a period exceeding 1 year. Now, current assets are the assets which are related to the trading activities of the business, e.g. inventory, e.g. receivables, e.g. cash, e.g. bank balance, and these assets are expected to last for a period less than 1 year. So we will start by recording assets, which we classify into two, non-current and current, and then from there we record capital, and then finally we record liabilities. Liabilities equally are classified into two, non-current liabilities and current liabilities. So we start by recording assets here. We start by recording what? Assets, and basically we always start by recording the non-current assets. The non-current assets. So in this case, we just need to have a single column here. And I hope you can also be able to record the figures which were given in the trial balance. Yes. So we just need to write that our figures will be in thousands of shillings. So what we need to do is we go back to the trial balance. We check the non-current asset. Non-current asset, I've said, is an asset which is acquired by the business to help the business in terms of generating revenue. These include assets such as land, buildings, motor vehicle, furniture and fittings, and so on and so on. And this is also something you need to recall from what we covered in the topic of the ledger account. In the topic of the ledger account, I was able to explain what are the assets and so on. So therefore, from the trial balance, I think we have a number of assets. Can we go down there from where we have landed buildings? Can you see landed buildings? Yes. So I hope you can see landed buildings. Land and buildings. So the value for landed buildings there is what? Is 2,550,000. Now remember the format which I gave you. We say that when recording the asset here, that is the non-current asset, we record them here at the net book value. Value. So how do we compute the net book value of an asset at the end of the year, which is basically recorded here? The net book value of an asset at the end of the year is equal to the cost minus the accumulated depreciation at the start of the year. And the accumulated depreciation of the asset at the start of the year are the accumulated depreciations which we have in the trial balance. If you check on the trial balance which are given here, the last items down there, you can see we have accumulated depreciations. Those are accumulated depreciations at the start of the year, which are part of the trial balance. So other than deducting this accumulated depreciation at the start, we also list the depreciation for the current year. Depreciation for the current year. And basically this is the depreciation which is in the statement of a profit or loss. So that depreciation which we accounted for as an expense in the statement of profit or loss is the depreciation for the current year. So therefore, it's very, very important to note this. How do we compute net book value of the asset at the end? Take the cost minus accumulated depreciation at the start, which is in the trial balance, minus the depreciation for the current year, which is in the income statement or the statement of profit or loss. Now, if you check the depreciations which are in the trial balance down there, you'll be able to see those are depreciation for plant and machinery, motor vehicle, furniture, and fittings. So meaning that we don't have any depreciation for landed buildings. So basically, there is something I mentioned in our previous class. There are those assets which do not lose value. Like if you have land do not lose value. In fact, land appreciates. The value of land keep on increasing. So that's why you can see there is no depreciation for this. But if there was depreciation, then we would have taken the cost, which is 2,550,000, minus the accumulated depreciation at the start, basically, which is 0, minus the depreciation for the current year, which is equal to what? 0. And then in that case, we get the net book value at the end of the year. In this case, the net book value of landed buildings remains the same. I want us to move to the other asset, which is below landed buildings, and that is plant and machinery. So we will use this approach. So we take the cost which is in the trial balance, 1,600,000. And then I want us to use this formula. We must be together here so that we understand this. So this is the cost. Whatever you have here is the cost. I want us to list the accumulated depreciation at the start, which is in the trial balance. So who can tell us how much is the accumulated depreciation for plant and machinery in the trial balance? How much is that figure? down there in the trial balance, the accumulated depreciation at the start for plant and machinery. Yes, it is an amount of 447. Please, once you get the answer, type it in the chat box. Ndio mwalimu ajue kama tuko pamoja. Once you get the answer, type it in the chat box. Sasa? Yes, so that I know whether we are together. Are we moving together or we are lost? The mwalimu can only be able to know that this is where we are communicating in the chat box. That's where we communicate. Sasa? Yes, once you get the answer, type it there. That's the only way I can be able to know whether we are together. Yes, so the accumulated depreciation at the start is 447, 010. And then to this we less the depreciation for the current year. This is the depreciation which we computed as per note number 6, and also the depreciation which we recognized as an expense in the income statement. So who can give me that depreciation for this one? I think it was 400,000. Was it 400,000? The depreciation from the income statement for the current year? Yes or no? Is it 400,000? Is it 400,000? I'm only getting answers from Evans. The depreciation for the current year. Ukienda kwa income statement, you'll be able to see we have depreciation which is recognized as an expense. Is it 400,000? Yes. So that's basically how we compute the net book value. So before we do this, I want us to do the same for the other assets, because we also have other non-current assets, including motor vehicles. We will do the same. We take the cost, which is 843,000, minus the accumulated depreciation at the start of the year, which is in the trial balance. In the trial balance is a figure of 168,600. And then can you give me the depreciation for the current year? The depreciation for the current year from the income statement. The depreciation for the current year in the income statement. Give me that figure. Give me that figure in the chat box down there. You just need to go back to the income statement and you check how much is the depreciation for the current year. How much is the depreciation for the current year for motor vehicles? The one which we computed, it was 168,600. So do we have any other assets? I can't see any other. Asset. I can't see any other asset, any other non-current asset. So I think we have only those three. So what we need to do here is we compute now the net book value. So let's start with the plant and machinery. I will take 1 million, 1.6 million, 1.6 million minus 447, 010 minus 400,000, and I'm getting 752. 990. Oh, there is one which has skipped. Okay, I've not seen that one. Furniture and fittings. Yes, furniture and fittings, I've seen it. Yes, thank you for that. Furniture and fittings. We do the same. We take the cost, which is the 245,000. 245,000. We less the accumulated depreciation at the start, which is in the trial balance 14 to 40. How much was the depreciation for the current year? The depreciation for the current year from the income statement. The depreciation for the current year from the income statement in Esther, Benson, Paul, 625. That is 625. Okay, so having that now, can we compute these net book values? Let's compute these net book values. We compute these net book values. So confirm whether you have gotten that one for plant and machinery. Have you gotten 752,990? Yes. So we move now to the other one, motor vehicle. We have 843 minus 168.6. These two are the same. The accumulated depreciation at the start and also for the year. They are the same. These two figures here. Are they the same? For motor vehicle, the accumulated depreciation at the start and for the year. They are, okay, sawa. Okay, so let's get the net book value at the end. So I'm getting 505,800. 505,800. What about furniture and fittings? 245 minus 14.24 minus 30.625. And that will give us 200. 135. So therefore, that's basically how we compute the net book value of the assets, of the non-current assets at the end of the year. This formula is very, very important. You need to remember that formula moving forward. So if formula write it somewhere, write this formula somewhere is very, very important. This is now what we will be using moving forward. Okay. So having that, then we need to proceed and we record the current assets. The current assets. Now, for the current asset, we said are assets related to the trading activities of the business. These include assets such as inventory, cash at bank, prepaid expenses, and so on. So which asset do we have? And recall we said, once you go to the trial balance, and you're looking for assets, where do you look for this particular asset in the trial balance? Which column? Evans. Where do you check for this asset in the trial balance? Esther? Rin? Hussein, where do you check for the asset in the trial balance? Yes, we said you check them in the debit column. In the debit what? Column. If you can be able to remember that, that will make your work very easy. Will make your work very easy. Will make your work very easy. Very easy. Very easy. Sasa? Yes. So let's check the items on the debit column. Up there we have purchases which we dealt with in the income statement. Down there you can see return inwards, discount allowed, downstairs salaries and wages, rates, insurance, general expenses. All those are expenses, but we have trade receivables. Trade receivables. This is the amount of money expected from the debtors. So the trade receivables amount is the 552,000. But this amount, the reason why I'm writing it here is because it will have some adjustments. If you check on the workings we did, we said that there are two items which are to be adjusted to this. If you can be able to recall those workings which we did. The first adjustment to be made to this is the working which we did in relation to note number 4. In relation to note number 4, can we go to note number 4, additional information number 4? We are told the trade receivables include an irrecoverable amount of 84. So we said that irrecoverable amount should be deducted from this because out of this, the company expects that it will not be able to recover an amount of 8,400. We need to less it here. Then also in note number 5, we computed allowance for doubtful debt, which we said we recognize as an expense, and number 2, we also deducted here. So who can give me that allowance for doubtful debt? The allowance for doubtful debt which we computed as per note number 5. As per note number 5, how much was that? It was 27,180. So that's basically how we get the net amount of receivables. The amount which was written off and the allowance. So the allowance we said is an amount which is set aside to cater for the losses to be incurred once the customer fails to pay. It is recognized as an expense and also it is deducted from receivables. So this will give us a net amount of 516 for 20, 516 for 20. So confirm whether that is what you're getting. Is that what you're getting? Please confirm. I want us to finish this question and we do another one. We must do another one because I want us to wind up with this topic today. Is that what you're getting, Lynn? Is that what you're getting, Benson? Esther, is that what you're getting, Hussein? Is that what you're getting? Eunice? Paul? Yes. So then, what else do we have? Which other current asset do we have? Remember, we are taking the items appearing on the debit column. So below the receivables down there, I'm not interested with the items appearing on the last column of the trial balance. Those items cannot never be assets. Down there, you can see inventory. Inventory, which you record there, here is the closing, not the opening, because that is the opening. Below that, we have plant, motor vehicle, drawings, furniture. None of those is a current asset, but we have cash. Cash, that is a current asset, and that is an amount of 300. Then I can't see any other. Can we go to the additional information now? In the additional information number 1, we have the closing inventory, the inventory at the end of the year. The closing inventory here is recognized as a current asset. So the closing inventory at the end of the year had a value of 222, 600. And then below that, we have some rates which were paid in advance. So we said any expense which is paid in advance is a current asset. Any expense paid in advance. So we have prepaid rates. Prepaid rates, in that case, is an amount of how much? 10,500. 10,500. And then from there, we have note 3. Note 3, we have outstanding electricity. Outstanding electricity basically is an expense which has not been paid. An expense not yet paid is a current liability. We have dealt with note number 4 and note number 5 because note number 4, note number 5 are affecting receivables. Note number 6 is about depreciation. We have dealt with that. And then note number 7, we are told included in salaries and wages is an amount of 93 paid domestic workers. We said this is part of the drawings. Finally, note number 8 is about outstanding wages. Outstanding wages is basically a current what? Is a current liability. So basically in our case, we don't have any other current asset. So what we need to do is we get the total assets. So the total assets, we add all this. Let's add all this. We have 2550 plus 752, 990 plus 505, 800 plus 200, 135 plus 516, 420 plus 60, 300 plus 222, 600 plus 10.5. So I'm getting a figure of 4,818,745. 745. Is that what you're getting? Is that what you're getting, Paul? Yes, that is confirmed by Evans. That is confirmed. Yes. Now we said after getting this, we double underline. So double underline means what? We are based, that is the end of the first part. Because we are preparing this based on this equation, assets are equal to capital plus liability. So we are done with assets. So then from there, that's why we are double underlining. That is the end of the first part. We proceed to record what? Capital. So we record capital here. And capital, that one, I think, is the first item within the trial balance. That is the first item within the trial balance, which is 4,047,48, and then 430. And then to this, remember, during the current year, we had a loss. Can you remember the loss? Yes. So in case you have a profit you add it to this. But in case you have a loss you less it. So the net loss for the year. Can you give me that net loss, which we got in our income statement? In this case, you may decide to have 2 columns here or 1. You can't be penalized because of that. Sasa? Yes. You can use 2 columns or just 1. You can't be penalized because of that. Sasa? Yes. You can't be penalized because of that. You may decide there are different approaches. Kuna mwalimu atafunza hizi current asset aziweke hapa, akuwe na column 2. The current asset to be recorded here. Once you get the total, you take it. But in an exam, you can't be penalized because of that. What is marked in an exam are these final figures. The person who is marking will not be interested whether you have 2 columns or 1 column. Sasa? Yes. So you can't be penalized because of either using 1 or 2 columns. Sasa? Yes. So I'm given the loss here, which was 171,155. And remember, loss should be deducted. We said what is the rule? Any figure which is to be deducted, record it here inside the bracket. Sasa? Yes. Then to this, we also left drawings. Now, drawings, we have 2. We have 2 drawings. So first of all, we have some drawings within the trial balance. I don't know whether you can see them. The drawings in the trial balance, just above the furniture and fittings. The drawings of how much? The drawings of 300. Can you see those drawings within the trial balance? Yes. Can you remember the other drawings? Who can be able to remember? We also have other drawings. I don't know whether you can be able to remember we have other drawings. Who can be able to remember those other drawings? Who can be able to remember the item to be treated as drawings? The item to be treated as drawings. The item to be treated as drawings is what? Is what we have in note number 7. What we have in note number 7. These salaries and wages which were paid to the domestic worker, to the domestic worker. That is basically like taking money from your business. You pay your personal expenses. That is a drawing. That is what? Drawings. It reduces the money you invested in your business. So that will give us what? That will give us a total drawings of how much? Total drawings of how much? Total drawings, 4,500. Yes. So then here we get the net capital. We get the net capital, or basically the capital at the end of the year. We work out that. We take the capital at the start, we less those 2 figures. 4748 minus 171, 155 minus 405, 300. I'm getting 4171, 975. Confirm whether that is what you're getting. Confirm. Is that what you're getting? Is that what you're getting? That's what you're getting? This minus that. Yes. So after getting capital, we proceed and record liabilities. Liabilities, we classify them into 2. Non-current liabilities and current liabilities. So here we always start by recording non-current liabilities. Non-current liabilities, we say that these are liabilities which are payable for a period exceeding 1 year. Now, we said in a sole proprietorship business, this can only take the form of a bank loan. The sole trader, the only non-current liability a sole trader may be having is a bank loan. So if you check on the information which you are given, and also you have to recall, we said when checking for the liabilities, you check the items appearing on the credit side of the trial balance. That's why we have liabilities. So on the credit side, no, Easter, we have to finish. Let's finish, and then I'll give you a short prayers break. Let's finish this. It should take us 5 minutes. We finish, and then I give you a short prayers break. Yes, let's proceed so that we finish. I give you a short prayers break. Okay, so on the credit side, what do we have? Up there, you can see we have capital. We have sales. Are those expenses? No. And in fact, if you check on that trial balance, there is nowhere we are given a bank loan, because as I'm saying, the only non-current liability a sole trader can have is a bank loan. So there is nowhere we have a bank loan here. And then finally, we record the current liabilities. Current liabilities, these are liabilities payable within a period of 1 year. We have a number of them. We have a number of them. Equally, when checking for liabilities, check the items appearing on the credit side of the trial balance. So up there, I can see we have capital, and I'm checking the items appearing in the last column of the trial balance. I can see we have what? We have a capital. Then down there, you can see we have sales, we have the return outwards. Down there, you can see we have discount. Down there, you can see we have payables, trade payables. Trade payables is the first current liability, trade payables. How much is that? That is an amount of 483,600. And then below that, we have equally a bank overdraft. A bank overdraft is still a current liability, and that is 120,600. So you can see all liabilities, they appear on the credit side of the trial balance. Then down there, we have accumulated depreciations. Accumulated depreciations are not automatically liabilities. Then can we go to the additional information so that we wind up? In the additional information, number 1, we have dealt with that. Number 2, we have dealt with that. But if you go to note number 3, we have outstanding electricity. In this case, we said any expense not yet paid at the end of the year is a current liability. Any expense not yet paid at the end of the year is a current liability. And that is an amount of how much? That is an amount of 5370. So then below that, we have note number 4 and 5. We have dealt with that because those two notes were affecting receivables. Note number 6 is about depreciation. Note number 7 is about drawings. And then finally, note number 8, we equally have outstanding salaries and wages. These are still current liabilities. Outstanding salaries and wages, which amount to how much? Which amount to 37,200. And basically, in our case, we are done. We are done. So what we need to do here is we get the total capital and liabilities. Total capital and liabilities. Total capital and liabilities, how do we get that? We take capital, this one, and then we add all these liabilities. We add all those liabilities. We should get a figure which is same to this. Confirm that 41,71,975 plus 483,600 plus 120,600 plus 5370 plus 37,200. That should give us a figure which is similar to this 48,18,745. 745. Is that what you're getting? Is that what you're getting? Yes. So therefore, whatever you get here, basically should be the same with the total asset, because we are preparing this based on the accounting equation. Asset, this one must be equal to capital plus liabilities. Yes. So that basically what is required. I want us, we have a short break, and then as we come back, I want us to look on another question. This is a question I want you to have as we come back. We have a question here which was examined, I think, in the sitting of May 2017. May 2017, question number 4. Question number 4. Can you take that question just as I confirm? Yes, so that is a question. That is a question I want you to have as we come back. So we take that short break. We come back at exactly 7 so that we do this question. So let's take that short break. Yes, so what are we told? We are told the following trial balance was extracted from the books of Joyce Merrill as at 30th of April 2017. So we have the inventory as at 1st May 2016, purchases, return outwards, cash in hand, bank balance, building at cost, salary expenses, stationery, legal fees. We have allowance for doubtful debt, trade receivables and trade payables, salaries, capital, selling and distribution cost, discount allowed and discount received, sales, equipment at cost, rates and insurance, return inwards, accumulated depreciation on 1st of May 2016 for building and for equipment. So then we have additional information, number 1 all the way to note number 6. And then what are we required to do? We are required to prepare the income statement for the year which ended 30th of April 2017. And part B, we are required to prepare the statement of financial position of these sole traders. So what I want us to do, I want us first of all, we go through the additional information which are given from note number 1 all the way to note number 6. We do some few workings, and then from there we prepare what is required in part A and also in part B. So let's go direct to additional information number 1. Additional information number 1. Remember, this is a question for May 2017, and this was the question number 4. So we start with some workings as per the additional information. So what are we told in the additional information number 1? In the additional information number 1, you're told allowance for doubtful debts is to be increased to 5 million. Is to be increased to 5 million. So basically what we said is that during the current financial year, as far as the allowance or the provision for doubtful debts is concerned, we consider, or basically what we account for in the income statement is the increase or decrease. Is the increase or decrease. So what we need to do, we need to go back to the trial balance and you tell me how much is the provision for doubtful debt at the start of the year, because that is what that provision for doubtful debt at the start of the year is given. So the allowance for doubtful debts, allowance for doubtful debts. So we have the allowance for doubtful debts at the start of the year. At the start of the year, this is the allowance for doubtful debts in the trial balance. And then we also have the allowance at the end of the year. So we compare the two, and basically we determine the increase or the decrease. So can we go back to let's go back to the trial balance. And in the trial balance, where do we have the allowance for doubtful debts? The allowance for doubtful debts in the trial balance is, where do we have that? That is somewhere in the middle of the trial balance. I don't know whether you can see it. Below the legal fees. So the allowance for doubtful debt in the trial balance, can you see that amount? Evans, Peter, Esther, Rin, can you see that amount? Yes, it is an amount of 35. That is the allowance for doubtful debt at the start. Then, if you go back to the trial balance up there, can you see what you're told in the trial balance up there? You can see the trial balance. We are given our figures up there in thousands of shillings. What does this mean? It basically means that all of the figures you're given in the trial balance, the last 3 zeros have been omitted. For example, in this case, the actual figure for this should be 3.5 million. Should be 3.5 what? Billion. So for you to be consistent, what you need to do is that anytime you are taking a figure from the additional information, also omit the last 3 zeros for you to be consistent. Are we together? Yes. So now, once we go to note number 1, we are told the allowance for doubtful debt at the end of the year will be increased to 5 million. But because our figures are in thousands of shillings, for us to be consistent, we equally omit the last 3 zeros. So then what we do, we compare these two allowances, the allowance at the start and the allowance at the end. We determine, do we have an increase or a decrease? But in our case, we are told it is an increase. So we have an increase in allowance for doubtful debt over 1,500. So this allowance for doubtful debt, remember we said, or this increase in allowance for doubtful debt, we said is an expense. So any increase in allowance for doubtful debt is what? Is an expense. But if it was a decrease, we said it is recognized as an income. As an income. And then when preparing our statement of financial position, this allowance for doubtful debt, this one, 5,000, this one is what we left from the receivables. From receivables, we left this one, allowance for doubtful debt at the end of the year. Not at the start, not the allowance at the start, not the increase. So we are done with that. Let's move to note number 2 because of time. Because of time. If you're off somewhere, you just let me know. So on note number 2, we are told rates as at 30th, okay, rates due as at 30th of April 2017 amounted to 500,000. Rates and expenses. Rates due, these are expenses, or these are rates which were not yet paid. So in that note, we are told there were rates due. They were rate due. In other terms, these are rates which were outstanding, the rates which are not being paid. So those rates had a value of 500,000. I've said we need to be consistent by omitting in all the figures we are taking from the additional information, we omit the last 3 zeros. So these rates which were due, number 1, we will add this to the rates which had already been paid. We add this now to the rate in the trial balance, and number 2, these rates not yet paid. This one is a current liability. This one is a current what? Liability. This one is a current liability. Evans is saying the internet is not stable. I hope it is your internet, Evans. I hope Mwalimu's video is clear for the other. For Tina Paul, is Mwalimu's video clear? Paul, Mpate, Nicole, can you get Mwalimu's video clearly? Okay. Yes, Evans, maybe you can try to follow up. Even if your network is not working, you can try to just follow up. Okay. So therefore, this rate not yet paid will be added to the rate already paid in the trial balance. And number 2, they'll be treated as a current liability. Number 3, inventory on that year, April 2017, was valued at 52 million. This crossing inventory, this one we will use it in computation of the cost of sales. It is also a current asset. No working share. Number 4, we are told drawings amounting to 10 million have been debited to the capital account. Drawings amounting to 10 million have been debited to the capital account. So basically, to debit drawings, or if you're told drawings have been debited in the capital account, it basically means that these drawings of 10 million have already been deducted from capital, because remember we said a capital has a credit balance. Capital has a credit what? Has a credit balance. So if you're told an item was debited in this account, it basically means that reduced the capital. The capital. So it basically means that during the current year, this sole trader had drawings of 10 million, but those drawings have already been accounted for. Do we need to account for them again if they have already been deducted from the capital? No, we don't need to deduct them again from the capital. Alternatively, you can do this. You take the figure of the capital in the trial balance, and I think it's a figure of 116,800. 116,800. You add this back then, this 10 million, but there is no need of doing that. Let's just ignore that, because these drawings of 10 million, they have already been deducted from the capital. So there is no way we are going to consider that transaction of 10 million. So the drawings have already been accounted for. They have already been deducted from the capital. So that note, we will not use it anywhere, because essentially that's how we treat a capital. That's how we treat drawings. We let it from capital. We move to note number 5, and I want us to compute the depreciation. The depreciation to be charged is to be charged on cost on the foreign rate. So let's compute those depreciations. And we are going to start by computing the depreciation on buildings. In this case, we are told this will be 5%. And I hope you can see in paragraph 1, we are told depreciation will be computed based on costs. What is the cost of buildings in the trial balance? The cost of buildings. Where do we have them? We have somewhere in the middle of the trial balance. In the middle of the trial balance, the buildings have a cost of 50 million. I hope you can see that. 50,000 in the middle of the trial balance somewhere. Can you see that? Esther, Rin, Peter, can you see that somewhere? Hussein, Nicole, Mpate, can you see that somewhere? Yes. So then we will be able to compute that. We also compute the depreciation on equipment. Which is 10% of the cost. So the cost of equipment, where do we have equipment? We have them down there. downstairs somewhere, basically 5,000. So 10% of this is 500. 5% of this would be 25. 2,500. 2,500. That should be the depreciation for the current year. Are you getting those values? 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 Eunice, Esther, Rin, you're getting those values? Those values, is that what you're getting? Is that what you're getting, Juma? Yes. So then finally, note number, this remember was working number 3, working number 4, in note number 6. In note number 6, we are told insurance amounting to 200,000 relate to the year which ended 30th of April 2018. So the current year, if you check on the requirement, ended 30th of April 2017. So we are told insurance of 200,000 relate to the following year. So which name will be given to those insurance? To those insurance expenses which relate to the following financial year? To the following financial year, but automatically were paid during the current year. Which name do we give to those insurance expenses or to that insurance expense? Paid during the current year, but it is for the next financial year. Yes, that one is known as a prepaid expense. Is a prepaid expense. So specifically prepaid insurance. Specifically prepaid what? Insurance, prepaid insurance. Prepaid insurance of 200,000. Over 200,000. So this 200,000, the prepaid insurance, number 1, this one will be treated as a current asset in our statement of financial position. And number 2, we less this from insurance expense. We also less this from the insurance what? Expense. We less that from the insurance expense. So that basically are the adjustment. Having that, I want us to quickly move now and basically prepare what is required. Starting with the part A of the question. In part A, we are required to prepare the income statement. So we have the name, the title. The title, we start with the name of the sole trader, Joyce Mero. This is the income statement. The income statement, basically, which is for the year, which ended 30th of April 2017. 30th of April 2017. 2017. So let's prepare this together. We prepare this together. So here we said we need to have 2 columns. We need to have 2 columns. And in this case up there, we will be able to indicate that our figures are in thousands of shillings. In thousands of shillings means that those figures which you're going to write here, the last 3 zeros have been omitted. The last 3 zeros have been omitted. So what do we start with here? We start with the sales. We start with the sales. When we have sales, remember you said sales is an income. We check this on the credit side of the trial balance. So the sales, I can be able to see that when we have the sales, it should be on the credit side. The sales, yes, I can see that somewhere above the equipment, below the discount around a discount received, which is an amount of 229,950. So to this we said we less the return inwards, or basically the sales return, the return inwards or the sales return. So the return inwards, do we have return inwards in our question here? Yes, I think there is somewhere. So or was it return outwards? Do we have return Yes, we have returned inwards from the bottom of the trial balance, above the accumulated depreciation, we have returned inwards over 1550. 1550, we get the net sales here. We get the net sales. So the net sales will be 229,950 minus 1550. 228,400. So that will be our net sales. So after getting the net sales, we said we proceed and we compute the cost of sales, or basically the cost of goods sold. The cost of sales or the cost of goods sold. How do we compute this one? Quite simple. We take the opening inventory. To this we add purchases. To this we add purchases. We also add carriage inwards. Carriage inwards. We less purchases return. Purchases return, which is also known as the return outwards. And then we will be able to get something called the goods available for sale. After getting the goods available for sale, remember you said we proceed and less the closing inventory. But before we do that, and we record these items. So the opening inventory, this is the first item within the trial balance. In the trial balance, the opening inventory is 50,000. We have that working in the first column. So purchases is the second item within the trial balance. Is that a figure of 170,020? 170,020? Yes, I think so. 170,020. And then to this, we add carriage inwards. In this question, do we have carriage inwards? I've not seen carriage inwards somewhere. I've not seen carriage inwards. Eunice, Marine, do we have carriage inwards? I've not seen any. I've not seen any. Yes, but we have a return outwards. Return outwards, we have it up there in the trial balance. Up there in the trial balance, the third item, which is 46. 46. And then we will be able to get now the goods available for sale. The goods available for sale. So the goods available for sale here will be what? We have 50,000 plus 170,020 minus 4,600, which will give us 215,420. 215,420. Confirm whether you're getting that. Is that what you're getting? Yes, 215,420. Then to this, what do we need to do? What do we need to do? Eunice, are you getting the same? Benson, Zuma, are you getting the same? Nicole, are you getting the same? I presume that is correct. That is correct. Okay. So then from there, what do we less? We less the closing inventory. Closing inventory is in the additional information. Additional information number 3. Additional information number 3, which is an amount of 52,000. Remember, in this case, we have said when taking any figure from the additional information, we must remember to omit the last 3 zeros. That's why you can see I'm taking that figure as 52,000, not 52 million, as 52,000. The figure which we get will be the cost of sales. We take it to the last column. So what will be our cost of sales here? Our cost of sales is 163,420. 420. Confirm whether that is what you're getting. Are you getting that figure? Is that what you're getting as the costs of sales? 163,420. So we less that from the net sales. We less that from the net sales. 228,400. And I'll get 64,980. 64,980, what is this? This is the gross profit. That is the gross profit, So after getting the gross profit, what do we do? To this, we add other incomes. We add other incomes. So the other incomes, in this case, include the discount received, include the decrease in provision for doubtful debts, include the rent received, the investment income, and so on. Now, when checking for incomes, also we said check the items appearing in the on the credit column, of the trial balance. That's where you get incomes. So just check the items appearing in the last column of the trial balance. So up there, you can see we have return outwards. Basically, that is not an income. Down there, I can see we have allowance for doubtful debt, but we said what we may consider here in relation to allowance is a decrease. If, for example, this was a decrease, we consider that here as an income. But in our case, it's an increase, meaning it's an expense. Down there, I can see we have payables. Down there, I can see we have capital. And then down there, I can see a figure of 46. That figure of 46, that is a discount received. That is a discount received. And in this case, you can see the examiner here basically try to catch you by basically giving those items together. Discount received, discount allowed. You have to recall discount allowed is an expense. If it's an expense, automatically discount allowed is the one appearing in the debit column. Discount received as an income, automatically should be on the credit side of the trial balance. That's what you just need to record there. Then down there, you can see we have sales. We have considered that here. And then we have accumulated depreciation down there. In the additional information, we don't have any other income here. So what we need to do is we get the total incomes. We get the total incomes here. Total incomes. Total incomes will be what? Will be 64,980 plus 46. Plus 46, I'm getting 69. 69, 580, 580, 580 like that. Yes. So then after getting this, we basically move and we less the expenses. We move and we less the expenses. We less the expenses. Now recall what we said here. Recall what we said. We said when dealing with the expenses, it is always advisable you start by deducting the expenses affected by the additional information. That's what we said. So we will first of all deal with these particular expenses affected by our additional information. Later on, we take the expenses not affected by the additional information. Let's go to note number 1. Note number 1 is affecting what? Note number 1, allowance for doubtful debt. We computed this increase. This increase we said is an expense. So we say here the first expense will be the increase in allowance for doubtful debt. So the increase is 1,500. It is an expense. So then below that we have the rate. Rate is the one which is affected by note 2. And basically rate we have rate which were outstanding. So the first thing we need to do, we go back to the trial balance, we check how much were the rates which were paid in the trial balance, because the rate we have in the trial balance are the rates which were paid. Where do we have the rate? The rates are given together with the insurance. So we have rates and insurance. Okay, so the rates and insurance is an amount of how much? Is an amount of 4,000. Is an amount of 4,000. So this rate, 1, we have to add this amount of 500. These rates which were not yet paid, we add them. And also recall, we have an adjustment for insurance. Insurance is part of this. So the adjustment for insurance, I hope you can remember this prepaid insurance. We said we less that from the insurance. So to this, we less 200. We less 200. You can see those two adjustments for it. For insurance have been adjusted here because the rate and insurance are part of that. Then we get the final figure here. Final figure, which will be 4,300. 4,300. 4,300. 4,300. Is that what you're getting? Is that what you're getting, Rin? Esther, Eunice, Juma, Benson. Okay, so we are done with that. So let's move to note number 3. Note number 3 is about crossing inventory. That has nothing to do with the expenses. Note number 5. Note number 4, we said this one will not have any adjustment because these were drawings which have already been accounted for. They have already been deducted from capital. So we don't have to account for them somewhere. Or we don't have to account for them here. So number 5 is about depreciation. We have these two depreciations. These are expenses. The depreciation on buildings. Depreciation on buildings is 25. Depreciation on equipment is 500 like that. 500 like that. So we are done with the note number 5. Note number 6, we are also through with it because that was affecting insurance. And I think we have already dealt with the insurance. So after doing that, what do? We go back to the trial balance, we pick the expenses which were not affected by the additional information. Sasa, yes. And basically for us to be able to do that, we have to recall that all expenses appear in the debit column. The first column is the trial balance. So let's check those items. The first item is inventory purchases. We have dealt with those. Down there, cash in hand, which is an asset. Cash bank balance is an asset. Building is an asset. And then below that, we have sundry expenses. Sundry expenses. So for the sundry expenses, that is an amount of how much? An amount of 840. So below that, we have the stationery. Stationery still is an expense. Stationery. These are the items which are used in the office, which is 1640. So below stationery, what do we have? We have the legal fee. The legal fee is still an expense. Legal fees, which is an amount of 280. And then down there we have receivables, an amount of 36, which is an asset. I can then see we have salaries. Have we dealt with salaries here? No. The salaries amount to how much? Amount to 39,000. 39,000. And then down there you can see we have selling and distribution. Selling and distribution costs. Selling and distribution costs, which amount to 1,600. And then down there you can see we have discount. Discount allowed is the one which appears on the debit column because that is an expense. Discount allowed, which is an amount of 6,300. Okay. So then down there you can see we have equipment. Then below equipment we have rate and insurance. Remember, you've already dealt with the rate and insurance here. Rate and insurance, we have already dealt with that one. Then down there we have return and accumulated depreciation. So we are done with all expenses. We are done with all expenses. Basically, what we need to do is we get the total expenses, we take them to the last column, and basically we deduct them from our total incomes. I hope there is nothing we have skipped. Have we omitted any expense? I think no. Okay, let's get the total expenses. 15 plus 43 plus 25 plus 500 plus 840 plus 1640 plus 280 plus 39,000 plus 1600 plus 63. I'm getting 58, 460. So we need to less this from our total income here, 69,580. And I'm getting 11,120. 11,120. Because that is a positive figure, that is a net profit for the year. a net profit for the year. A net profit for the, is that what you're getting? Net profit. Net profit, same. Rin, Eunice, Esther, are you getting that? Please confirm so that we proceed. Yes, confirmed. So let's move to part B. In part B, we are required to prepare the statement of financial position of this sole trader. A statement of financial position as at that year of April 2017. As at that year of April 2017. Yes, so here we start by recording assets, basically which we classify into two, non-current assets and current assets. Non-current assets and current assets. So in this case, I've said, let's just be using one column. I've said you can either use two columns or just one. You can't be penalized because of using two or one column. Sasa, let's just get used to using one. Because even at the higher level, once you go to financial, to CP intermediate level, you'll also be able to do this topic, financial statements, mostly of a published company. You'll be using one column, including the income statement, you'll be using one column. Yes, so let's just get used to one column. So which non-current asset do we have here? We have a number of them. Also remember assets. Assets have a debit balance. So I'm told that the profit is 111. 11. The profit is what? No, Zuma, is that correct? Is our profit this one? 1120. No, Zuma, that is not correct. Our profit is 11,120. That is our profit. That is our profit. Yes, confirmed. Okay. So let's record now the non-current asset because of time. So non-current assets, they have a debit balance in the trial balance. So which non-current asset do we have? I think first of all, I can see buildings. Can you see buildings somewhere? Up there? Yes. So what is the cost of buildings? The cost of buildings is 50,000. 50,000. To this cost, we left two items. We left accumulated depreciation at the start. Remember what you have done in the other question. I've given you a starting formula, which I've said is very, very important. Accumulated depreciation at the start, which is in the trial balance, and the depreciation for the current year, which is an expense here. So the accumulated depreciation at the start is in the trial balance down there. The last item in the trial balance, 11,400. And then I will also less the depreciation for the current year, this one. So that I get the net book value at the end. That one you must understand it, because I know this is one of the area majority of the students don't get it wrong. Eunice, can you understand what you're doing here? Esther, Rin, can you understand what you're doing here? Yes. This is one of the area I know majority of the students encounter a problem. How do we compute the value of an asset at the end? You take its cost minus the accumulated depreciation at the start minus the depreciation for the current year. So which other asset do we have? I can also see we have equipment down there. Equipment, the cost is 5,000. I will less the accumulated depreciation at the start, which is 1770, and also the depreciation for the current year, which is 500. So that I get the net book value at the end. Minus 1770 minus 500. I'm getting 27, 2730. 2730. Is that what you're getting? 2730, 2730. 2730, confirmed. Okay. So I don't think we have any other non-current assets. I can't see any other non-current asset. Or do we have any other? Do we have any other non-current assets? Do we have any other non-current asset? I can't see any. So we move and record the current assets. We move and record the current assets. The current asset. So which current asset do we have? So within the trial balance, first of all, case we are told it is an increase. So we have an increase in allowance for doubtful debts over 1,500. So this allowance for doubtful debts, remember we said, or this increase in allowance for doubtful debts, we said is an expense. So any increase in allowance for doubtful debts is what? Is an expense. But if it was a decrease, we said it is recognized as an income. And then when preparing our statement of financial position, this allowance for doubtful debts, this one, 5,000, this one is what we less from the receivables. From receivables, we less this one, allowance for doubtful debts at the end of the year, not at the start, not the allowance at the start, not the increase. So we are done with that. Let's move to note number 2 because of time. If you're off somewhere, you just let me know. So on note number 2, we are told rates as at that year's, rates due as at that year of April 2017 amounted to 500,000. Rates are expenses. Rates due, these are expenses, or these are rates which were not yet paid. So in that note, we are told there were rates due. In other terms, these are rates which were outstanding, the rates which are not being paid. So those rates had a value of 500,000. I've said we need to be consistent by omitting in all the figures we are taking from the additional information, we omit the last 3 zeros. So these rates which were due, number 1, we will add this to the rates which had already been paid. We add this now to the rate in the trial balance. And number 2, these rates not yet paid, this one is a current liability. This one is a current what? Liability. This one is a current liability. Evans is saying the internet is not stable. I hope it is your internet, Evans. I hope Mwalimu's video is clear for the other. For Kina Paul, is Mwalimu's video clear? Paul, Mpate, Nicole, can you get Mwalimu's video clearly? Okay. Yes, Evans, maybe you can try to forward, even if your network is not working. You can try to just follow up. Okay. So therefore, this rate not yet paid will be added to the rate already paid in the trial balance. And number 2, they'll be treated as a current liability. Number 3, inventory on that year, April 2017, was valued at 52 million. This crossing inventory, this one we will use it in computation of the cost of sales. It is also a current asset. No working there. Number 4, we are told drawings amounting to 10 million have been debited to the capital account. Drawings amounting to 10 million have been debited to the capital account. So basically, to debit drawings, or if you're told drawings have been debited in the capital account, it basically means that these drawings of 10 million have already been deducted from capital, because remember we said a capital has a credit. They are not stable. I hope it is the internet, Evans. I hope this video is clear for the other. For Tina Paul, is Molimu's video clear? Paul, Mpate, Nicole, can you get Molimu's video clearly? Okay. Yes, Evans, maybe you can try to forward, even if your network is not working. You can try to just follow up. Okay. So therefore, this rate not yet paid will be added to the rate already paid in the trial balance. And number two, they'll be treated as a current liability. Number three, inventory on that is April 2017 was valued at 52 million. This closing inventory, this one we will use it in computation of the cost of sales. It is also a current asset, no working care. Number four, we are told drawings amounting to 10 million have been debited to the capital account. Drawings amounting to 10 million have been debited to the capital account. So basically, to debit drawings, or if you're told drawings have been debited in the capital account, it basically means that these drawings of 10 million have already been deducted from capital, because remember we said a capital has a credit balance. Capital has a credit what? Has a credit balance. So if you're told an item was debited in this account, it basically means that reduced the capital. That reduced the capital. So it basically means that during the current year, this sole trader had drawings of 10 million, but those drawings have already been accounted for. Do we need to account for them again if they have already been deducted from the capital? No, we don't need to deduct them again from the capital. Alternatively, you can do this. You take the figure of the capital in the trial balance, and I think it's a figure of 116,800. 116,800. You add this back then, this 10 million, but there is no need of doing that. Let's just ignore that, because these drawings of 10 million, they have already been deducted from the capital. So there is no way we are going to consider that transaction of 10 million. So the drawings have already been accounted for. They have already been deducted from the capital. So that note, we will not use it anywhere, because essentially that's how we treat a capital. That's how we treat drawings. We let it from capital. We move to note number 5, and I want us to compute the depreciation. The depreciation to be charged is to be charged on cost on the foreign rate. So let's compute those depreciations. And we are going to start by computing the depreciation on buildings. In this case, we are told this will be 5%. And I hope you can see in paragraph 1, we are told depreciation will be computed based on cost. What is the cost of buildings in the trial balance? The cost of buildings. Buildings, where do we have them? We have somewhere in the middle of the trial balance. In the middle of the trial balance, the buildings have a cost of 50 million. I hope you can see that. 50,000 in the middle of the trial balance somewhere. Can you see that? Esther, Rin, Peter, can you see that somewhere? Hussein, Nicole, Mpate, can you see that somewhere? Yes. So then we will be able to compute that. We also compute the depreciation on equipment. Which is 10% of the cost. So the cost of equipment, where do we have equipment? Equipment, we have them downstairs. Somewhere, basically 5,000. So 10% of this is 500. 5% of this would be 25. 2,500. That should be the depreciation for the current year. Are you getting those values? Eunice, Esther, Rin, you're getting those values? Is that what you're getting? Is that what you're getting, Juma? Yes. So then finally, note number, this remember was working number 3, working number 4, in note number 6. In note number 6, we are told insurance amounting to 200,000 relate to the year which ended 30th of April 2018. So the current year, if you check on the requirement, ended 30th of April 2017. So we are told insurance of 200,000 relate to the following year. So which name will be given to those insurance? To those insurance expenses which relate to the following financial year? to the following financial year, but automatically were paid during the current year. Which name do we give to those insurance expenses or to that insurance expense? Paid during the current year, but it is for the next financial year. Yes, that one is known as a prepaid expense. Is a prepaid expense. So specifically prepaid insurance. Specifically prepaid what? Insurance, prepaid insurance. Prepaid insurance. The prepaid insurance, number one, this one would be treated as a current asset in our statement of financial position. And number two, we less this from insurance expense. We also less this from the insurance what? Expense. We less that from the insurance expense. So that basically are the adjustment. Having that, I want us to quickly move now and basically prepare what is required. Starting with the part A of the question. In part A, we are required to prepare the income statement. So we have the name, the title. The title, we start with the name of the sole trader, Joyce Mero. This is the income statement. The income statement, basically, which is for the year, which ended 30th of April 2017. 30th of April 2017. 2017. So let's prepare this together. We prepare this together. So here we said we need to have two columns. We need to have two columns. And in this case up there, we will be able to indicate that our figures are in thousands of shillings. In thousands of shillings means that those figures which you're going to write here, the last 3 zeros have been omitted. The last 3 zeros have been omitted. So what do we start with here? We start with the sales. We start with the sales. When we have sales, remember you said sales is an income. We check this on the credit side of the trial balance. So the sales, I can be able to see that where do we have the sales? The sales, it should be on the credit side. The sales, yes, I can see that somewhere above the equipment, below the discount around a discount received, which is an amount of 229,950. So to this we said we less the return inwards, or basically the sales return, the return inwards or the sales return. So the return inwards, do we have return inwards in our question here? Yes, I think there is somewhere. So, or was it return outwards? Do we have return? Yes, we have return inwards. From the bottom of the trial balance, above the accumulated depreciation, we have return inwards of 1550. 1550, we get the net sales here. We get the net sales. So the net sales will be 229,950 minus 1550. 228,400. So that will be our net sales. So after getting the net sales, we said we proceed and we compute the cost of sales, or basically the cost of goods sold. The cost of sales or the cost of goods sold. How do we compute this one? Quite simple. We take the opening inventory. To this we add purchases. To this we add purchases. We also add carriage inwards. Carriage inwards. We less purchases return. Purchases return, which is also known as the return outwards. And then we will be able to get something called the goods available for what? For sale. After getting the goods available for sale, remember you said we proceed and less the closing inventory. But before we do that, can we record these items? So the opening inventory, this is the first item within the trial balance. In the trial balance, the opening inventory is 50,000. We have that working in the first column. So purchases is the second item within the trial balance. Is that a figure of 170,020? 170,020? Yes, I think so. 170,020. And then to this, we add carriage inwards. In this question, do we have carriage inwards? I've not seen carriage inwards somewhere. I've not seen carriage inwards. Eunice, Marine, do we have carriage inwards? I've not seen any. I've not seen any. I've not seen any. Yes, but we have a return outwards. Return outwards, we have it up there in the trial balance. Up there in the trial balance, the third item, which is 46. 46. And then we will be able to get now the goods available for sale. The goods available for sale. So the goods available for sale here will be what? We have 50,000 plus 170,020 minus 4,600, which will give us 215. 215 for 20. 215 for 20. Confirm whether you're getting that. Is that what you're getting? Yes, 215 for 20. Then to this, what do we need to do? What do we need to do? Eunice, are you getting the same? Benson, Zuma, are you getting the same? Nicole, are you getting the same? I presume that is correct. That is correct. Okay. So then from there, what do we less? We less the closing inventory. Closing inventory is in the additional information. Additional information number 3. Additional information number 3, which is an amount of 52,000. Remember, in this case, we have said, when taking any figure from the additional information, we must remember to omit the last 3 zeros. That's why you can see I'm taking that figure as 52,000, not 52 million, as 52,000. The figure which we get will be the cost of sales. We take it to the last column. So what will be our cost of sales here? Our cost of sales is 163, 420, 420. Confirm whether that is what you're getting. Are you getting that figure? Is that what you're getting as the costs of sales? 163 for 20. So we less that from the net sales. We less that from the net sales. 228, 400. And I'll get 64, 980. 64, 980, what is this? This is the gross profit. That is the gross profit, the gross profit. So after getting the gross profit, what do we do? To this, we add other incomes. We add other incomes. So the other incomes, in this case, include the discount received, include the decrease in provision for doubtful debts, include the rent received, the investment income, and so on. Now, when checking for incomes, also we said check the items appearing in the on the credit column, of the trial balance. That's where you get incomes. So just check the items appearing in the last column of the trial balance. So up there, you can see we have a return outwards. Basically, that is not an income. Down there, I can see we have allowance for doubtful debt, but we said what we may consider here in relation to allowance is the decrease. If, for example, this was a decrease, we consider that here as an income. But in our case, it's an increase, meaning it's an expense. Down there, I can see we have payables. Down there, I can see we have capital. And then down there, I can see a figure of 46. That figure of 46, that is a discount received. That is a discount received. And in this case, you can see the examiner here basically try to catch you by basically giving those items together. Discount received, discount allowed. You have to recall discount allowed is an expense. If it's an expense, automatically discount allowed is the one appearing in the debit column. Discount received as an income automatically should be on the credit side of the trial balance. That's what you just need to record there. Then down there, you can see we have sales. We have considered that here. And then we have accumulated depreciation down there. In the additional information, we don't have any other income here. So what we need to do is we get the total incomes. We get the total incomes here. Total incomes. Total incomes will be what? Will be 64,980 plus 46. Plus 46, I'm getting 69. 69, 580, 580, 580 like that. Yes. So then after getting this, we basically move and we less the expenses. We move and we less the expenses. We less the expenses. Now recall what we said here. Recall what we said. We said when dealing with the expenses, it is always advisable you start by deducting the expenses affected by the additional information. That's what we said. So we will first of all deal with these particular expenses affected by our additional information. Later on, we take the expenses not affected by the additional information. Let's go to note number 1. Note number 1 is affecting what? Note number 1, allowance for doubtful debt. We computed this increase. This increase we said is an expense. So we say here the first expense will be the increase in allowance for doubtful debt. So the increase is 1,500. It is an expense. So then below that we have the rate. Rate is the one which is affected by note 2. And basically rate we have rate which were outstanding. So the first thing we need to do, we go back to the trial balance, we check how much were the rates which were paid in the trial balance, because the rate we have in the trial balance are the rates which were paid. Where do we have the rate? The rates are given together with the insurance. So we have rates and insurance. Okay, so the rates and insurance is an amount of how much? Is an amount of 4,000. Is an amount of